If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Chapter 1. Money Isn't the Worst. Seriously. Part 1. Understanding Your Money Psychology. Your relationship with money started forming long before you received your first paycheck or opened a checking account. Erin Lowry discovered this truth at 7 years old when she convinced her father to let her sell Krispy Kreme donuts to his coworkers. She bought a dozen for $6 and sold them individually for $1 each, making $6 profit. Her excitement lasted until her father sat her down with a calculator. He deducted gas money for the trip to the store, time costs for the shopping expedition, and other expenses she hadn't considered. Her profit margin shrank dramatically, but the lesson expanded her understanding forever. This childhood experience perfectly demonstrates how early encounters with money shape our adult financial behaviors. Whether your parents fought about bills behind closed doors, treated money discussions as forbidden territory, or splurged beyond their means, these moments created your financial blueprint. Netflix CEO Reed Hastings grew up in a household where his mathematician father meticulously tracked every expense. This early exposure to financial precision influenced Hastings' later business decisions, including Netflix's data-driven approach to content creation and subscriber management. The childhood lessons about measurement and analysis became foundational to his corporate leadership style. Your money psychology falls into predictable patterns. Lowry identifies 3 distinct millennial financial personalities based on years of research and reader interactions. Team YOLO FOMO lives for immediate gratification, spending on experiences and purchases without considering future consequences. These individuals often justify expenses by saying life is short and memories matter more than bank balances. Team Guarded Optimist represents the middle ground. They acknowledge the importance of saving and planning, but consistently overestimate their future earning potential. A software engineer earning $75,000 might assume they'll make $150,000 within 5 years, leading them to justify current overspending based on projected income that may never materialize. Team Dreaming About Retirement swings to the opposite extreme. These individuals obsess over future financial security to the point of sacrificing present happiness. They might save 50% of their income while living in substandard conditions. Missing opportunities to invest in relationships, health, or career development that could improve their overall well-being. Understanding which team describes your current approach helps identify blind spots in your financial decision-making. The goal isn't choosing the correct team, but recognizing how your psychology influences your choices. Part 2. Identifying your financial starting point. Your childhood dinner table conversations about money matter more than you might realize in shaping your financial future today. The uncomfortable truth is that your family's approach to money created a blueprint that still controls your spending decisions decades later. Sarah Chen, a marketing manager from Portland, discovered this when she realized she was repeating her mother's pattern of secret shopping sprees followed by guilt-induced budgeting attempts. Her parents never fought about money openly, but the tension was palpable whenever bills arrived. Take a moment to examine your earliest money memories. Did your parents argue behind closed doors about credit card bills? Maybe they treated money discussions like classified information, changing the subject whenever you asked about family finances. Or perhaps they lived paycheck to paycheck while maintaining appearances with expensive cars and designer clothes. These childhood experiences create what psychologists call money scripts, unconscious beliefs that drive adult financial behavior. Dr. Brad Klotz's research at Kansas State University identified 4 primary money scripts that develop during childhood and persist into adulthood. If your parents constantly worried about having enough money, you might have developed a scarcity mindset that makes you hoard cash even when investing would serve you better. Jake Morrison, a software developer from Austin, kept $50,000 in a savings account, earning 0.1% interest, because his Depression-era grandmother repeatedly warned him that banks can't be trusted with investments. Conversely, growing up in a household where money solved every problem might have taught you that spending equals happiness. This explains why some people use retail therapy to cope with stress, unconsciously believing that purchases can fix emotional problems. Family silence around money often produces adults who avoid financial conversations entirely. They might procrastinate on opening retirement accounts or delay discussing finances with partners because money talks feel inherently uncomfortable or dangerous. The key insight is recognizing these patterns without judgment. Your money psychology isn't right or wrong. It's simply information. Lisa Park realized her tendency to overspend on friends stemmed from childhood experiences where her parents' financial stress meant fewer social activities. As an adult, she unconsciously overcompensated by always picking up dinner checks. Understanding your financial starting point requires honest assessment of both your bank account and your emotional relationship with money. This foundation determines whether budgeting strategies will actually stick or become another failed attempt at financial improvement. Part 3. Confronting Money Myths and Beliefs. Your parents probably told you to buy a house because rent is throwing money away, and your Instagram feed screams that investing requires thousands of dollars sitting around collecting dust. These inherited beliefs about money often trap us in financial decisions that made sense for our parents' generation, but completely miss the mark for today's economic reality. Take the homeownership myth that dominated American thinking for decades. Sarah Johnson, a 28-year-old marketing coordinator in Austin, spent 3 years obsessing over saving for a down payment because her parents insisted renting was financial suicide. Meanwhile, housing prices in her area jumped 15% annually, while her savings crawled forward at 2%. When she finally ran the numbers, renting actually freed up $800 monthly that she invested in index funds. Those investments grew faster than home equity would have in her market. The investment myth proves equally destructive. Michelle Schroeder-Gardner, founder of Making Sense of Sense, started investing with just $25 per month through automatic transfers. Her tiny contributions eventually grew into a $1 million portfolio. Yet countless people still believe you need substantial wealth before investing makes sense, missing years of potential compound growth while waiting for some magical threshold. Credit cards represent another misunderstood tool. Dave Ramsey preaches complete avoidance, but travel hacker Chris Guillebeau uses credit card rewards strategically to fund international adventures worth thousands annually. The difference lies in understanding your spending patterns and self-control, not blanket rules inherited from financial gurus. Even the college education assumption deserves scrutiny. Mike Rowe advocates for skilled trades that often pay more than many college degrees while avoiding student debt entirely. Yet societal pressure pushes millions toward expensive degrees for careers that barely cover loan payments. Question every piece of financial wisdom you've absorbed without examination. Does the advice account for your specific situation, goals, and local economic conditions? Your grandmother's investment strategy might have worked in 1985, but today's economy demands different approaches. The most dangerous money beliefs feel like universal truths because everyone repeats them. Start examining these assumptions individually. What evidence supports each belief? How does your situation differ from the people who originally gave this advice? Sometimes the smartest financial move is ignoring conventional wisdom that no longer serves your reality. Part 4. Creating your money mission statement. Your money mission statement acts as your financial GPS, preventing you from wandering aimlessly through countless spending decisions and investment options. Think of Target's mission statement: to help all families discover the joy of everyday life. Every decision the company makes gets filtered through this lens. Your personal money mission works the same way. When faced with buying another streaming service or investing in a retirement account, Your mission statement provides the answer. Consider Sarah, a 28-year-old graphic designer who spent years bouncing between extreme frugality and impulsive splurges. She would meal prep for weeks, then blow her grocery savings on designer clothes. Her financial life lacked direction because she never defined what money meant to her personally. Sarah's breakthrough came when she wrote her money mission. Money gives me freedom to create without compromise and security to take creative risks. This simple sentence transformed her spending habits. The designer clothes failed the mission test, but investing in professional development courses passed easily. Your mission statement should answer 3 fundamental questions. What role does money play in your ideal life? What experiences or security do you want money to provide? How do you want to feel about money decisions? Netflix CEO Reed Hastings built his company around the mission of giving people the freedom to watch whatever they want, whenever they want. This clarity guided decisions from content acquisition to global expansion. Your money mission needs similar focus. Start by examining your authentic desires versus societal expectations. Do you actually want homeownership, or do you think you should want it? Does early retirement excite you, or would you prefer funding creative projects throughout your career? Write down moments when you felt genuinely happy about money decisions. Maybe it was paying for your friend's birthday dinner without stress, or having enough saved for an unexpected opportunity. What values were you honoring in those moments? Your mission might emphasize security. Money protects my family from unexpected hardships and provides peace of mind. Or it could prioritize experiences. Money funds adventures and creates memories with people I love. Does that justify skipping retirement contributions for your child's college fund? Remember, your money mission can evolve as your life changes. The key is having clear guidance for today's decisions while remaining flexible for tomorrow's circumstances. Chapter 2. Dealing with the dreaded B word, Budgeting. Part 1. Why budgets fail and how to make them work. Most budgets fail because they treat you like a financial robot instead of a human being with real feelings and messy lives. The statistics are brutal. Research from the National Foundation for Credit Counseling shows that 77% of people abandon their budgets within the first month. That's not because you lack willpower. It's because traditional budgeting advice fundamentally misunderstands how humans actually think about and spend money. Think about the last budget you tried. If you're like most people, you probably created an overly ambitious plan that looked great on paper, but crashed into reality faster than a house of cards. Maybe you allocated exactly $200 for groceries without considering that you actually hate meal planning and usually grab takeout twice a week. Or perhaps you tried the envelope method because it worked for your organized friend, even though handling cash makes you uncomfortable and you forget envelopes at home constantly. The biggest mistake people make is treating budgeting like dieting. They impose draconian restrictions that eliminate all joy from spending. Then wonder why they cheat and blow their budget on a shopping spree 3 weeks later. Behavioral economist Dan Ariely's research at Duke University demonstrates that people consistently overestimate their future self-control while underestimating their present desires. Your Tuesday night self might commit to never buying coffee out, but your Thursday morning self, running late with no caffeine, operates under completely different priorities. Successful budgets work because they align with your actual personality and spending triggers, not because they follow someone else's perfect system. Consider Michelle, a marketing coordinator who failed at detailed spreadsheet tracking for years before discovering that she needed a simple 3-bucket approach: essentials, savings, and everything else. Her budget finally stuck because it matched her big-picture thinking style, rather than forcing her into granular categories that felt overwhelming. The goal isn't perfection or punishment, it's awareness and intentionality. When you understand why traditional approaches fail and choose methods that actually fit how your brain works. Budgeting transforms from a source of guilt into a tool that helps you spend money on things you genuinely value while building the financial future you want. Part 2. Choosing your budgeting method. Think of choosing a budgeting method like dating. What works for your best friend might be completely wrong for you. The key is finding your financial personality type first. Start with the envelope method if you're someone who needs to see and touch money to understand it. Dave Ramsey made this famous, and it still works brilliantly for people who overspend on cards. Take cash for each spending category: groceries, entertainment, gas, and put it in separate envelopes. When the envelope is empty, you're done spending in that category. Sarah, a teacher from Ohio, tried this after maxing out 3 credit cards and found that physically handing over cash made her pause before every purchase. She paid off $12,000 in debt using this tactile approach because it forced her to confront every spending decision. If you love data and spreadsheets, build a detailed tracking system. This works well for analytical personalities who enjoy seeing patterns and trends. Create categories for everything from coffee to car repairs. Track every penny for 3 months to establish your baseline. Then, set realistic limits based on actual spending rather than wishful thinking. Mark, a software engineer, built an elaborate Excel spreadsheet that automatically calculated spending percentages and flagged overspending. This method satisfied his need for precision while keeping him accountable. For people who want simplicity, try the 50-30-20 rule. Allocate 50% of after-tax income to needs, 30% to wants, and 20% to savings and debt payments. This percentage-based approach requires minimal maintenance once you automate transfers. Elizabeth Warren popularized this method because it's sustainable without being overwhelming. You don't need to track every coffee purchase. Just ensure your major categories stay within bounds. Tech-savvy millennials often prefer apps like YNAB or Mint that sync with bank accounts and categorize transactions automatically. These tools provide real-time spending updates and can send alerts when you approach category limits. The automation removes friction while maintaining awareness. Test different methods for at least a month each. Your first choice probably won't be your final choice, and that's completely normal. The method that feels effortless after initial setup is usually the winner. Part 3. Tracking expenses and identifying spending leaks. Knowing where your money goes versus where you think it goes represents the difference between financial control and financial chaos. Most people drastically underestimate spending in categories like food and entertainment, while completely forgetting about recurring charges that silently drain their accounts monthly. Start with a spending audit by gathering 3 months of bank and credit card statements. Don't rely on memory or guesswork. Your brain lies about money. Starbucks CEO Howard Schultz discovered this principle when customer surveys claimed people visited once weekly, but transaction data revealed daily visits. Your spending patterns follow similar disconnects between perception and reality. Create categories that match your actual life, not textbook examples. If you spend money on pet supplies, create that category instead of lumping it under miscellaneous. Personal finance expert Erin Lowry found clients often had categories like Target runs because that store defied traditional categorization. Household items mixed with clothes, mixed with groceries in one transaction. Track every expense for 30 days using whatever method feels easiest. Receipt photos, notebook jotting, or app logging all work if you actually do them consistently. The goal is data collection, not perfection. Financial advisor Suze Orman tracked expenses on napkins during her waitressing years, proving sophistication matters less than consistency. Look for subscription services you forgot existed. Americans waste approximately $79 monthly on unused subscriptions, according to Truebill research. That forgotten gym membership from January or streaming service you signed up for during a free trial adds up to nearly $950 annually. Log into your bank account and identify any recurring charges you can't immediately justify. Examine small, frequent purchases that accumulate into significant amounts. That daily $4 coffee represents $1,460 annually, enough for a solid emergency fund start. The problem isn't the coffee itself, but the unconscious nature of the spending. Comedian Jerry Seinfeld jokes about not knowing his spending because it's only money leaving electronically. But this disconnect costs real wealth-building opportunities. Focus on spending that provides genuine value and satisfaction. Cut ruthlessly from categories that don't enhance your life while protecting spending that aligns with your priorities. A friend who spent $200 monthly on books felt guilty until realizing this supported her career development goals, making it money well spent. Meanwhile, she canceled $80 in unused app subscriptions without missing them. The spending audit reveals patterns, not judgment. Use this information to make conscious choices about where your money goes, rather than wondering where it went. Part 4. Building flexibility into your budget. Most budgets fail because they assume you're a robot who never wants ice cream or faces car repairs. Real life demands flexibility, not rigid rules that crumble when reality hits. Think of your budget like a GPS system. When you take a wrong turn, GPS doesn't shut down and declare the trip ruined. It recalculates and finds a new route to your destination. Your budget should work the same way. Buffer categories solve the irregular expense problem. Netflix costs $15 monthly, but car maintenance might be $300 twice yearly. Instead of pretending car repairs don't exist, budget $50 monthly into a car maintenance fund. When that $300 bill arrives, you're ready instead of stressed. Rolling funds work brilliantly for seasonal expenses. Christmas happens every December, yet millions act surprised by gift expenses. Set aside $40 monthly starting in January, and you'll have $480 for holidays without using credit cards. Apply this concept to vacation funds, wedding gifts, or home repairs. Priority-based spending adjustments keep you sane. Say you budgeted $100 for dining out, but got invited to a friend's birthday dinner that costs $120. Instead of saying no or blowing your budget completely, adjust by cutting $20 from entertainment that month. You maintain the overall spending level while accommodating real social needs. The 50-30-20 rule provides natural flexibility. Allocate 50% for needs, 30% for wants, and 20% for savings and debt payments. Within the wants category, you can shift money between dining, entertainment, and shopping based on monthly priorities. If you spend less on clothes one month, you have more for experiences. Emergency splurge funds prevent budget destruction. Budget $25 to $50 monthly for completely irrational purchases. When you desperately want those overpriced concert tickets, use splurge money without guilt. This prevents the all-or-nothing mentality that destroys budgets. For irregular income like freelancing or sales commissions, base your budget on conservative estimates. If your income ranges from $3,000 to $6,000 monthly, budget using $3,000. Extra money in high-earning months goes towards savings or debt payments, creating stability during lower months. Track your flexibility usage. If you constantly need budget adjustments, examine whether your categories are realistic. Maybe you allocated too little for groceries or underestimated transportation costs. Budgets should stretch, not snap. The goal isn't perfect adherence, but consistent progress. A budget that bends with life's curveballs while keeping you moving toward financial goals beats a rigid system you abandon after 3 weeks. Flexibility builds sustainable habits, not financial guilt. Chapter 3. Picking the right financial products. Part 1. How banks profit from your ignorance. That bank teller smiling at you across the counter isn't just being friendly. They're potentially eyeing your wallet. Banks operate on a simple principle that most customers never fully grasp. They make money when you don't pay attention. Chase Bank alone collected over $2.4 billion in overdraft fees in 2019, averaging about $34 per fee. That's not an accident or unfortunate side effect. It's a carefully designed revenue stream that depends on your lack of awareness. Consider Sarah, a 26-year-old marketing coordinator who discovered she was paying $12 monthly for a checking account that offered nothing she couldn't get free elsewhere. Over 5 years, that's $720 she handed to her bank simply because she never questioned the fee structure. When she finally switched to an online bank with no monthly fees, she realized her parents' bank choice had been costing her money for years. The overdraft system represents banks' most profitable customer trap. When your account drops below zero by even a few cents, many banks hit you with a $35 fee. Buy coffee for $4.50 when you have $4.48? You just paid $39.50 for that latte. Wells Fargo faced multiple lawsuits for reordering transactions to maximize overdraft fees, processing larger debits first to drain accounts faster. ATM fees create another steady income stream. Your bank charges you $2.50 for using another bank's machine. Then that bank adds its own $3 fee. Suddenly, withdrawing $20 costs $25.50. Banks collected $5 billion in ATM fees in 2020, money that could stay in customers' pockets with minimal planning. Minimum balance requirements work like invisible taxes. Drop below $1,500 in your checking account, and boom, $15 monthly fee. Banks profit twice. They use your deposited money to make loans while charging you for the privilege of keeping it there. The solution isn't complex, but it requires action. Online banks like Ally or Capital One 360 offer checking accounts with no minimum balance, no monthly fees, and ATM fee reimbursements. Credit unions typically provide better rates and lower fees than traditional banks because they operate as member-owned cooperatives rather than profit-maximizing corporations. Understanding these mechanisms transforms you from passive customer to informed consumer. Banks count on customer inertia, the tendency to stick with familiar institutions despite better options. Breaking that pattern puts money back in your pocket where it belongs. Part 2. Comparing checking and savings account options. The 4 main banking options available today each serve different purposes, but choosing wrongly can cost you hundreds of dollars annually. Traditional banks like Chase or Bank of America offer extensive branch networks and familiar brand recognition, yet often charge monthly maintenance fees ranging from $5 to $15. These institutions excel when you frequently need in-person services or cash deposits from checks, but their savings accounts typically offer interest rates below 0.1%, essentially nothing. Online banks represent the opposite approach. Ally Bank, Marcus by Goldman Sachs, and Discover Bank eliminate overhead costs from physical branches, passing those savings to customers through higher interest rates and fewer fees. Their savings accounts often provide 4 to 5% annual percentage yields, meaning $10,000 earns $400 to $500 yearly instead of $10 at traditional banks. The trade-off involves limited physical locations and potential delays for cash deposits. Credit unions operate as member-owned cooperatives rather than profit-driven corporations. Navy Federal Credit Union and Alliant Credit Union typically offer better rates and lower fees than traditional banks while maintaining personal service. However, membership requirements can limit eligibility. Some require military connections, employment at specific companies, or geographic residence. Hybrid options combine multiple approaches. Charles Schwab offers checking accounts with unlimited ATM fee reimbursements worldwide, making them ideal for frequent travelers. Capital One 360 provides both online efficiency and physical locations in major cities. Your life situation determines the best choice. Students benefit from accounts with no minimum balances and fee waivers, making online banks or credit unions preferable. Freelancers who receive numerous checks might need traditional banks for easier deposits. International travelers should prioritize accounts with foreign transaction fee waivers and ATM reimbursements. Interest rates matter more than most people realize. A traditional bank savings account with $5,000 earning 0.01% generates 50 cents annually. The same amount in an online high-yield account earning 4.5% produces $225. Over 5 years, that difference totals over $1,000. Compare accounts systematically using these criteria: monthly fees, minimum balance requirements, ATM access and fees, interest rates, mobile app functionality, and customer service ratings. Many people choose convenience over cost, staying with banks near their workplace or home, despite better options existing online. The biggest mistake involves maintaining multiple unnecessary accounts. Simplify by selecting one checking account for daily expenses and one high-yield savings account for emergency funds and goals. This approach reduces complexity while maximizing earnings and minimizing fees. Remember that switching banks requires effort but provides ongoing benefits. Set up direct deposits, update automatic payments, and transfer funds systematically. The temporary inconvenience pays dividends through lower costs and higher returns for years ahead. Part 3. Understanding high-yield savings and money market accounts. Your traditional savings account earning 0.01% interest essentially guarantees you'll lose money to inflation. High-yield savings accounts represent one of the simplest ways to make your money work harder without taking any additional risk. These accounts typically offer interest rates 20 to 50 times higher than traditional savings accounts. While your neighborhood bank might pay you pennies on every $1,000, online high-yield accounts often provide rates above 4% annually. The math becomes startling when you calculate real numbers. Consider Sarah, who keeps $10,000 in emergency savings. At her local bank, earning 0.01%, she makes $1 per year. Moving that same money to a high-yield account earning 4.5% generates $450 annually. Over 5 years, the difference amounts to over $2,200 in additional earnings for making one simple switch. Online banks achieve these superior rates because they operate without expensive physical branches. They don't pay rent for prime real estate locations, hire armies of tellers, or maintain costly ATM networks. These savings get passed directly to customers through higher interest rates and lower fees. Money market accounts offer similar benefits with slightly different features. They typically provide higher interest rates than traditional savings, while allowing limited check writing privileges. Some money market accounts require higher minimum balances but compensate with even better rates for larger deposits. Many people hesitate to move money online due to safety concerns. This worry proves largely unfounded. Legitimate online banks carry the same FDIC insurance, protecting deposits up to $250,000 per account. Your money enjoys identical federal protection, whether stored at Chase Bank or Ally Bank. The FDIC has never failed to protect insured deposits since its creation in 1933. Accessibility concerns also prove manageable. While you can't walk into a physical branch, most high-yield accounts offer mobile apps, online transfers, and ATM access through partner networks. Many reimburse ATM fees, making cash access more convenient than traditional banks with limited branch locations. The compound effect of higher interest rates becomes particularly powerful over time. Marcus by Goldman Sachs customers saw their savings grow substantially faster than traditional bank customers during recent years of rising interest rates. Even when rates fluctuate, high-yield accounts consistently outperform traditional alternatives. Traditional banks still make sense in specific situations. If you frequently need in-person banking services, maintain complex business relationships with your bank, or prefer having all accounts in one location, the convenience might justify lower returns. However, most millennials conduct banking primarily online anyway, making high-yield accounts the logical choice for emergency funds and short-term savings goals. Part 4. Evaluating credit cards and rewards programs. Most credit card marketing feels designed to confuse you into making expensive mistakes rather than helping you choose wisely. Credit card companies spend billions on advertising because they know most people select cards based on flashy welcome bonuses or celebrity endorsements rather than understanding the fine print. Chase Sapphire Reserve's launch in 2016 created such demand that the company temporarily ran out of metal to make cards. Yet many applicants never calculated whether the $450 annual fee made financial sense for their spending habits. The key to smart credit card selection starts with honest self-assessment. Track your spending for 3 months across categories like groceries, gas, dining, and travel. Sarah, a marketing coordinator in Denver, thought she needed a travel rewards card because she dreamed of exotic vacations. When she actually reviewed her bank statements, she discovered 60% of her spending went to groceries and rideshares, making a simple 2% cashback card worth $200 more annually than the premium travel card she was considering. Different reward structures serve different lifestyles. Cashback cards offer simplicity and immediate value. You spend money, you get money back. The Citi Double Cash Card gives 2% on everything without categories to track. Travel rewards cards work best for people who actually travel frequently and understand how to redeem points effectively. Rotating category cards, like the Chase Freedom, require active management but can yield 5% back on specific spending if you remember to activate each quarter. Annual fees deserve careful calculation. A card with a $95 annual fee needs to earn you at least $95 more in rewards than a free alternative to break even. The American Express Blue Cash Preferred charges $95 annually, but offers 6% back on groceries up to $6,000 per year. If you spend $200 monthly on groceries, you earn $144 in rewards, making the fee worthwhile. Spend only $100 monthly and you lose money. Reading credit card terms protects you from expensive surprises. The APR matters enormously if you carry balances, though responsible users pay cards off monthly regardless of interest rates. Foreign transaction fees typically cost 2 to 3% per purchase abroad, significant for frequent travelers. Grace periods give you time to pay without interest, but cash advances often accrue interest immediately. The most dangerous mistake is treating credit cards as emergency funds or income supplements. Cards should build credit history and earn rewards on money you already plan to spend, not enable lifestyle inflation you cannot afford. Chapter 4. Credit Reports and Scores, the Report Card for Life. Part 1. Understanding what affects your credit score. Knowing these 5 credit score components helps you spend your energy where it actually makes a difference, instead of wasting time on tactics that barely move the needle. Payment history carries the heaviest weight at 35% of your credit score. Think of it as your financial report card attendance record. Every single payment, whether on time or late, gets reported to credit bureaus. Capital One's research shows that even one 30-day late payment can drop a good credit score by 60 to 110 points. The solution seems obvious, but life happens. Set up automatic minimum payments for all your credit accounts. Even if you pay the full balance manually later, this safety net prevents catastrophic late payments that follow you for 7 years. Credit utilization accounts for 30% of your score and measures how much credit you use compared to your available limits. Here's where most people get confused. You don't need to carry debt month to month to build credit. Credit card companies report your statement balance, not whether you paid it off. If your limit is $1,000 and your statement shows $300, that's 30% utilization, regardless of whether you pay the full $300 before the due date. Keep your utilization below 10% for excellent scores, though under 30% is acceptable. Sarah, a 28-year-old teacher, saw her score jump from 720 to 780 simply by paying down her balances before statement closing dates, instead of waiting until due dates. She didn't change her spending habits or pay more money, just shifted the timing. Length of credit history represents 15% of your score. This rewards time, not perfection. Your average account age and oldest account both matter. That's why keeping your first credit card open makes sense, even if you don't use it regularly. Just put a small recurring charge on it every few months to keep it active. Credit mix makes up 10% of your score. Having different types of credit accounts shows lenders you can manage various payment structures. This includes credit cards, auto loans, mortgages, and personal loans. Don't take on unnecessary debt just to improve your mix, but understand that responsible management of different account types strengthens your profile. New credit inquiries account for the final 10%. Each hard inquiry typically drops your score by 5 points temporarily. Multiple inquiries for the same type of loan within 14 to 45 days count as one inquiry. So shop around for mortgages or auto loans without fear. Part 2. Accessing and reading your credit reports. Getting your hands on your credit reports should happen 3 times per year, not once. Most people know about the free annual reports, but miss the strategic timing. Pull one report every 4 months from a different bureau. Equifax in January, Experian in May, TransUnion in September. This rotation gives you year-round monitoring without spending a dime. The only legitimate website for free reports is annualcreditreport.com. Ignore the commercials promising free scores with monthly fees hidden in fine print. The Federal Trade Commission mandates this single portal, and it connects directly to all 3 major credit bureaus without upselling you anything. When Sarah Martinez first accessed her reports in 2019, she discovered a mortgage inquiry she never made and a credit card account opened in her name at a store she'd never visited. These discoveries saved her from months of identity theft damage that could have destroyed her credit for years. Your credit report contains 5 main sections that tell your financial story. Personal information includes your name, addresses, social security number, and employment history. Credit accounts show every card, loan, and line of credit you've opened, including balances, credit limits, and payment patterns. Payment history details every late payment, missed payment, or account closure. Hard inquiries list every time someone checked your credit for lending decisions. Public records capture bankruptcies, tax liens, and court judgments. Reading these reports feels overwhelming at first, but focus on accuracy over perfection. Check that personal information matches your records. Incorrect addresses might signal identity theft. Verify that all accounts belong to you and show accurate balances and payment histories. Look for accounts you closed that still appear open, which can hurt your utilization ratio. The inquiry section often contains surprises. Promotional inquiries from companies pre-screening you for offers don't affect your score, but they clutter your report. Hard inquiries from actual applications should match your memory of applying for credit. Most people scan reports looking for obvious errors but miss subtle problems. Account ownership matters. Being listed as an authorized user versus a joint account holder carries different credit implications. Payment history should reflect your actual payment patterns, not generic codes that misrepresent your behavior. Set calendar reminders for your report rotation schedule. Credit bureaus don't automatically share information, so an error on one report might not appear on others. This systematic approach transforms credit monitoring from yearly panic to routine maintenance, catching problems while they're still manageable. Part 3. Disputing errors and handling collections. That error on your credit report won't fix itself, and waiting costs you money every month in higher interest rates. Finding errors is only half the battle. When Sarah discovered a collections account for a medical bill she never received, her credit score had already dropped 78 points. The key lies in understanding that credit bureaus operate under specific legal requirements that most people never learn to use in their favor. The Fair Credit Reporting Act gives you powerful tools, but only if you use them correctly. Start with the credit bureau's online dispute system for simple errors like wrong addresses or account numbers. However, complex disputes require written letters sent via certified mail. Keep every piece of documentation, bank statements, payment records, and correspondence with creditors in a dedicated file. Target one error at a time rather than sending massive dispute letters. Credit bureaus have 30 days to investigate legitimate disputes. If they cannot verify the information, they must remove it. Rebecca learned this when disputing a late payment that wasn't hers. She provided bank records showing her payment cleared on time, and the Bureau removed the negative mark within 3 weeks. Collections accounts demand a different strategy entirely. Never admit the debt is yours during initial conversations with collectors. Instead, request written validation of the debt within 30 days of first contact. This forces collectors to prove they own the debt and that the amount is accurate. Consider pay-for-delete agreements where you offer to pay the collection in exchange for complete removal from your credit report. Get this agreement in writing before sending any payment. Marcus negotiated a pay-for-delete on a medical collection by offering $400 upfront, improving his credit score by 45 points within 2 months. The Fair Debt Collection Practices Act protects you from harassment. Collectors cannot call before 8 a.m. or after 9 p.m., contact you at work if you've told them not to, or use threatening language. Document violations and report them to the Consumer Financial Protection Bureau. Track your disputes using spreadsheets with dates, reference numbers, and outcomes. Some people see results in 30 days, while complex cases may take 6 months. The process feels overwhelming initially, but each successful dispute builds confidence for handling future issues. Remember that patience beats aggression. Credit bureaus respond better to organized, factual disputes than emotional appeals. Treat this as paperwork management, not personal vindication, and watch your credit score climb as errors disappear. Part 4. Building credit from scratch or rebuilding after damage. Starting from zero credit or climbing back from a damaged score feels like trying to build a house without tools. But thousands of people do it successfully every year using simple, proven methods. Your credit journey begins with understanding your starting point. If you're building from scratch, you need 3 basic tools: a secured credit card, consistent bill payments, and time. Capital One and Discover offer excellent starter cards that require a security deposit matching your credit limit. Put $200 down, get a $200 limit, and use it for small purchases like gas or groceries. Pay the full balance every month without exception. Sarah, a 22-year-old college graduate, started with no credit history in 2019. She opened a secured card with a $300 deposit, used it for her monthly Spotify subscription, and paid it off religiously. 18 months later, her score reached 720, and she qualified for an unsecured card with cashback rewards. Credit builder loans work differently, but equally effectively. Companies like Self-Lender hold your loan money in a savings account while you make monthly payments. After completing the loan term, you get your money back plus a positive payment history. This strategy helped Marcus rebuild his credit after student loan defaults dropped his score to 490. Becoming an authorized user on someone else's account can accelerate progress, but choose carefully. The primary cardholder's payment history affects your score, so partner with someone who pays bills on time consistently. Make sure the card issuer reports authorized users to credit bureaus. Not all do. Recent immigrants face unique challenges since international credit history doesn't transfer. Maria moved from Mexico in 2020 with no U.S. credit. She opened a secured card, became an authorized user on her sister's account, and used Experian Boost to add utility payments to her credit report. Within 2 years, she qualified for a mortgage. Recovery from bankruptcy requires patience above all else. Chapter 7 bankruptcy stays on your report for 10 years. But you can start rebuilding immediately. Focus on secured cards and consider credit builder loans once the bankruptcy is discharged. Student loan defaults create specific challenges since federal loans don't disappear in bankruptcy. Contact your loan servicer about rehabilitation programs that remove default status after 12 consecutive on-time payments. This single action can boost your score by 100 points or more. Alternative credit reporting through services like Experian Boost adds utility, phone, and streaming service payments to your credit file. While not all lenders use these services, they provide additional positive payment history for thin credit files. Expect realistic timelines. New positive accounts appear within 1 to 2 months, but meaningful score improvements take 6 months to a year of consistent behavior. Chapter 5. Wait, I shouldn't just pay the minimum due on my credit card? Part 1. The true cost of minimum payments. Let's look at Sarah's real credit card statement to see how minimum payments work in practice. She has a $2,500 balance on a card with 18.99% APR. Her minimum payment? Just $62. Sounds reasonable, right? But here's the math that credit card companies hope you never calculate. If Sarah only makes minimum payments, she'll spend the next 17 years paying off this debt. The total cost? $6,300. That means she'll pay $3,800 just in interest charges, more than her original balance. Credit card companies design minimum payments to maximize their profits while appearing affordable to customers. Most companies set minimums at 2 to 3% of your balance. This low percentage ensures you'll carry debt for years while they collect substantial interest payments. Bank of America, for example, calculates minimums as the greater of $35 or 1% of your balance plus interest charges. This formula guarantees they receive their interest money while barely touching your principal. Let's compare two scenarios using Mike's $5,000 credit card balance at 21% APR. Making minimum payments of $125, Mike will need 23 years to become debt-free and pay $9,743 in total, nearly double his original debt. But if Mike pays $200 monthly instead, he'll eliminate the debt in just 2.5 years and pay only $6,157 total. That extra $75 per month saves him over $3,500 and 20 years of payments. The compound interest trap becomes clearer when you realize how payment allocation works. Most of your minimum payment goes to interest, not principal. In Mike's first month, only $37 of his $125 payment reduces his actual debt. The remaining $88 goes straight to the credit card company as profit. This explains why balances seem impossible to shrink despite making regular payments. Credit card companies rely on customer confusion about these calculations. They benefit when you focus on the small monthly payment instead of the total cost. Understanding this profit model changes everything. Once you see how minimum payments trap you in expensive long-term debt cycles, paying more than the minimum becomes a financial emergency, not a suggestion. HTML, APR divided by 365 equals daily periodic rate. Balance times daily rate times days in billing cycle equals interest charge. Part 2. Understanding how credit card interest actually works. Most credit cards charge interest that compounds daily, turning your 18% APR into something much worse than it appears. The annual percentage rate gets divided by 365 days, creating what banks call the daily periodic rate. For an 18% APR card, your daily rate becomes 0.049%. This might sound tiny, but it compounds every single day you carry a balance. Here's how your credit card company calculates what you owe them each month. They take your average daily balance, multiply it by that daily rate, then multiply by the number of days in your billing cycle. A $3,000 balance on an 18% APR card costs you about $45 in interest charges monthly. But here's the catch most people miss. Different types of transactions carry different interest rates on the same card. Cash advances typically charge 25% or higher, with no grace period. Balance transfers might start at 0% but jump to 21% after the promotional period ends. Regular purchases get the advertised rate, but only if you pay your full balance monthly. Miss one payment and your rate can spike to the penalty APR, which averages around 29%. The grace period only applies to new purchases when you carry no balance from the previous month. Most people think they have 25 days to pay without interest, but this protection disappears the moment you carry any balance forward. Once you're carrying debt, every new purchase starts accruing interest immediately. Payment application order determines how much interest you pay. Credit card companies must apply payments above the minimum to your highest rate balances first, but minimum payments go to lowest rate balances. This means if you have a promotional 0% balance and regular purchases at 18%, your minimum payment pays down the 0% balance while the 18% debt grows. Capital One faced regulatory action in 2012 for misleading customers about how payments were applied. They were charging interest on paid-off promotional balances because customers didn't understand the payment hierarchy. This cost consumers millions in unnecessary interest charges. Promotional rates create another trap. That 0% APR for 18 months becomes retroactive interest if you don't pay off the entire promotional balance by the deadline. Store cards are notorious for this practice, charging interest back to the original purchase date on any remaining balance. Understanding these mechanics lets you verify your monthly statements and catch errors. Banks make mistakes, and knowing how interest calculations work protects you from overpaying. More importantly, this knowledge helps you make strategic decisions about which cards to pay off first and how to structure your payments for maximum impact. Part 3. Strategies for paying off credit card debt faster. Credit cards companies love when you make minimum payments because they've designed this system to keep you paying for years. Michelle from Portland discovered this harsh reality when she calculated that her $3,200 balance would take 27 years to pay off, making only minimum payments, costing her over $5,000 in interest charges. The good news is that even small increases in your monthly payments create dramatic results. Adding just $25 extra to Michelle's minimum payment would cut her payoff time to 5 years and save her $3,200 in interest. This happens because extra payments attack the principal balance directly rather than getting eaten up by interest charges. The avalanche method targets your highest interest rate card first, while making minimums on others. List all your cards with balances, interest rates, and minimum payments. Put every extra dollar toward the highest APR card until it's gone, then move to the next highest rate. This approach saves the most money mathematically, but requires patience since high-rate cards might not be your smallest balances. The snowball method flips this strategy by focusing on your smallest balance first, regardless of interest rate. Dave Ramsey popularized this approach because early wins create momentum and motivation. When Jessica from Chicago paid off her $480 department store card in 2 months, the psychological boost helped her tackle her larger balances with renewed energy. A hybrid approach combines both methods strategically. Start with any balance under $500 to build momentum, then switch to the avalanche method for larger debts. This gives you quick wins while optimizing long-term savings. Balance transfers can accelerate progress if handled correctly. Moving high-interest debt to a 0% promotional rate card creates breathing room, but transfer fees typically cost 3 to 5% of the balance. Only transfer amounts you can realistically pay off during the promotional period. Set up automatic payments to ensure the balance disappears before the promotional rate expires and interest charges kick in retroactively. Calculate your debt-free date under different payment scenarios. If you can pay $200 monthly instead of $75 minimums, you'll see exactly how many months you're cutting off your timeline. This concrete visualization makes extra payments feel worthwhile rather than abstract. Avoid lifestyle extremes that lead to burnout. Cutting every expense to zero while throwing everything at debt often backfires when you inevitably spend money on something enjoyable, then feel guilty and give up entirely. Build modest entertainment money into your debt payoff plan to maintain balance and sustainability. Track your progress monthly by noting how much principal you've paid down, rather than just focusing on remaining balances. Seeing $200 in principal payments provides motivation even when the total balance seems to move slowly. Part 4. Using credit cards strategically without carrying debt. Most people think credit cards are either pure evil or free money. Both views miss the bigger picture entirely. The key to using credit cards strategically is treating them like a debit card with benefits. This means never spending money you don't already have in your checking account. When Chase launched their Sapphire Reserve card in 2016, savvy users earned thousands in travel rewards by putting everyday expenses like groceries and utilities on the card, then immediately paying the balance from money already budgeted for those purchases. Your credit utilization ratio matters more than you think for your credit score. This number represents how much of your available credit you're using across all cards. Keep it below 30% of your total credit limit, but aim for under 10% for the best score impact. If you have a $1,000 credit limit, try to keep balances below $100 at statement time. Timing payments strategically helps maximize your credit score. Pay off most of your balance before the statement generates, leaving just a small amount to report. Then, pay that remaining balance before the due date. This shows credit usage without carrying debt month to month. Credit bureaus want to see you actively using credit, not avoiding it completely. Rewards programs only work when you pay balances in full monthly. The Costco Anywhere Visa card offers 4% back on gas purchases, but that benefit disappears instantly if you pay 18% interest on carried balances. Set up automatic full balance payments to eliminate the temptation of carrying debt for reward points. Track spending in real time rather than waiting for monthly statements. Use your bank's mobile app to check balances before making purchases. This prevents overspending and keeps your budget on track. Many successful credit card users photograph receipts immediately and enter amounts into budgeting apps. Choose cards that match your actual spending patterns. If you rarely travel, airline miles cards waste money on annual fees. A simple cashback card might serve you better. Target launched their Red Card offering 5% off all purchases, which provides more value than complex point systems for regular Target shoppers. The goal is building credit history while earning rewards, never paying interest. Credit cards become powerful financial tools when you remember they're not extending your income. They're temporarily fronting money you already have. Chapter 6. Yikes! I already have consumer debt. What now? Part 1. Assessing your total debt picture. Looking at your debt feels like opening a closet stuffed with everything you shoved inside for months. Scary, but absolutely necessary before you can actually clean it up. The first step requires brutal honesty. Gather every credit card statement, loan document, medical bill, and anything else you owe money on. Sarah Chen from Portland discovered she had 14 different debts spread across cards, store financing, a personal loan from her brother, and medical bills from an emergency room visit. She had been making minimum payments on some while completely ignoring others, creating a financial mess that felt impossible to manage. Create a simple spreadsheet or use a notebook to list everything. For each debt, write down the creditor name, total balance, minimum monthly payment, interest rate, and due date. This isn't about judgment, it's about facts. When Marcus Williams did this exercise, he found his $47,000 in total debt across 12 accounts. The number shocked him, but having it all in one place made it feel less overwhelming than the constant anxiety of not knowing. Many people avoid this step because seeing the total feels too painful. Rachel Martinez admits she cried when she added up her $23,000 in credit card debt, but she also describes the relief that followed. Finally knowing exactly what she faced instead of living with constant dread about mysterious amounts. Your debt inventory becomes your roadmap. Without it, you're driving blindfolded. With it, you can see which debts charge the highest interest rates, which payments are due when, and how much breathing room you have in your budget. This information becomes crucial for deciding which debts to tackle first and how aggressively you can pay them down. Don't skip this step because it feels uncomfortable. Real progress starts with real information. Jennifer Park discovered that 3 of her 8 debts had interest rates above 20%, while 2 others were promotional 0% rates expiring soon. This knowledge completely changed her payment strategy and saved her thousands in interest charges. The goal isn't perfection, it's clarity. Once you know exactly where you stand, you can build a realistic plan that actually works. Part 2. Debt Avalanche versus Debt Snowball Methods. 2 roads stretch before you when paying off debt, and choosing the wrong one could cost thousands extra. The debt avalanche method attacks your highest interest rate debts first. Think of it like stopping a leak in your roof. You fix the biggest hole before worrying about smaller drips. Sarah Martinez owed $15,000 across 4 credit cards with rates ranging from 14% to 24%. By targeting her 24% card first while making minimum payments on others, she saved $3,200 in interest compared to paying them equally. Here's how the avalanche works. List all debts by interest rate, highest to lowest. Pay minimums on everything, then throw every extra dollar at the highest rate debt until it's gone. Once eliminated, move to the next highest rate. Mathematically, this approach always wins. But humans aren't calculators. Enter the debt snowball method, which prioritizes smallest balances regardless of interest rates. Dave Ramsey popularized this approach because he understood something crucial. Personal finance is more personal than finance. When Michael Chen started with his smallest $400 medical bill instead of his highest rate credit card, something shifted. That first victory gave him momentum to tackle his $1,200 store card next. Within 6 months, he'd eliminated 3 debts entirely. The psychological boost kept him motivated through the longer haul of paying off larger balances. The snowball works like this. List debts by balance, smallest to largest. Attack the tiniest debt first while maintaining minimums elsewhere. Each eliminated debt creates excitement and proof that you can actually become debt-free. Research from Northwestern University found that people using the snowball method were 40% more likely to eliminate all their debts completely. Why? Because early wins build confidence and create habits that sustain long-term success. Neither method is universally superior. Consider your personality honestly. Do you get motivated by optimization and saving money, even if progress feels slow? Choose Avalanche. Do you need regular victories to stay committed to challenging goals? Pick Snowball. Sometimes hybrid approaches work best. Lisa Thompson used a modified strategy. She paid off her $300 store card first for a quick win, then switched to targeting high-interest debts. This gave her initial momentum while still minimizing long-term interest costs. The best debt payoff method is the one you'll actually stick with until every balance reaches 0. Part 3. Creating your personalized debt elimination plan. Your debt payoff method gives you direction, but now you need a concrete roadmap that actually works with your messy, real-world life. Start by calculating exactly how much extra money you can throw at debt each month. This isn't about finding hundreds of dollars you don't have. Sarah Martinez, a teacher from Phoenix, discovered she had only $47 extra monthly after covering all her expenses. That seemed pathetically small until she realized it could eliminate her $800 credit card debt in 18 months instead of the 30 years minimum payments would take. Write down every debt with its balance, minimum payment, and interest rate. Then decide which debt gets your extra money based on your chosen strategy. If you picked Snowball, that $47 goes to your smallest debt. If Avalanche, it goes to your highest interest rate debt. Everyone else gets just the minimum payment, no matter how tempting it feels to spread money around. Calculate your debt-free date for each account. This sounds complicated, but you can use free online calculators or apps like Debt Payoff Assistant. Seeing actual dates makes everything feel real instead of abstract. When Marcus Johnson from Chicago saw his student loan would be paid off by March 2026 instead of someday, he printed the calendar page and hung it in his kitchen. Build celebration milestones into your plan. Every time you pay off a debt, do something meaningful but cheap. Maybe it's a $10 dinner at your favorite restaurant or calling your best friend to share the news. These moments matter because debt payoff takes years, not months. Automate everything possible. Set up automatic minimum payments so you never accidentally miss one and trigger penalty fees. Then automate your extra payment too. When James Wright automated his extra $85 payment to his credit card, he stopped second-guessing the decision every month and started making real progress. Plan for life getting in the way. Your car will need repairs. You'll get invited to weddings. Build a small buffer into your budget so unexpected expenses don't derail your entire plan. The goal isn't perfection. It's consistent progress that eventually adds up to freedom. Your debt elimination plan should feel challenging but doable. If it requires you to eat ramen for 2 years, you'll quit. If it's too comfortable, you'll never finish. Part 4. Addressing the behaviors that created debt. Paying off debt without changing why you borrowed money in the first place is like bailing water from a boat without fixing the hole in the bottom. You can follow the perfect debt payoff plan, but if you don't address the behaviors that created your debt, you'll find yourself right back where you started. Studies show that 40% of people who pay off credit card debt end up accumulating the same amount again within 2 years. The reason? They never fixed their spending habits. Think about what drove you into debt in the first place. Was it emotional spending after a bad day at work? Keeping up with friends who make more money? Living in an expensive city without adjusting your lifestyle? Maybe you experienced lifestyle inflation, where each raise meant bigger expenses instead of bigger savings. Take Sarah, who paid off $15,000 in credit card debt only to rack up $12,000 more within 18 months. She realized her trigger was stress eating expensive takeout and shopping for clothes when work got overwhelming. Until she found cheaper ways to handle stress, debt payoff was just a temporary bandage. Start tracking your spending triggers for 2 weeks. Write down every purchase over $20 and what you were feeling when you made it. Were you tired, stressed, celebrating, or trying to impress someone? Look for patterns. Do you overspend on weekends, after payday, when you're with certain friends? Once you identify your triggers, create specific strategies to handle them differently. If you shop when stressed, make a list of 5 free stress busters like walking, calling a friend, or watching Netflix. If you overspend on nights out, suggest cheaper alternatives or set a cash limit before you leave home. Social pressure creates enormous spending pressure. When your friends want expensive dinners and you're paying off debt, suggest meeting for coffee instead. Real friends will understand your financial goals. If they don't, consider whether these relationships serve your best interests. Practice the 24-hour rule for purchases over $50. Walk away and think about whether you actually need the item or just want it in the moment. Most impulse purchases lose their appeal after a day. The goal isn't to never spend money on enjoyment. It's to spend intentionally rather than impulsively. When you understand why you accumulated debt, you can build systems to prevent it from happening again. Chapter 7. Student Loans. How to handle them without having a full-on panic attack. Part 1. Understanding your student loan types and terms. Think of your student loan situation like a medical diagnosis. You can't treat what you don't understand, and misdiagnosis leads to costly mistakes. Most borrowers treat their student loans like one big scary number without realizing they might be sitting on thousands of dollars in savings through programs they don't even know exist. Sarah from Ohio discovered she had been making payments on unsubsidized loans first, while her subsidized loans gathered dust, costing her an extra $2,400 in interest over 4 years, simply because she didn't understand the difference. Your first mission is determining whether you have federal or private loans. This isn't just academic curiosity. It determines everything from your repayment options to your safety nets. Log into the National Student Loan Data System at studentaid.gov using your FSA ID. This government website shows every federal loan you've ever taken. If you see loans missing from this list that appear on your credit report, those are private loans. Federal loans come in three main flavors. Subsidized loans are the golden child. The government pays your interest while you're in school and during certain deferments. Unsubsidized loans start accumulating interest immediately, even while you're cramming for finals. Plus loans, taken by parents or graduate students, typically carry higher interest rates and fewer protections. Private loans are the Wild West. Each lender creates their own rules. Interest rates vary dramatically, and you have minimal consumer protections. Jessica learned this the hard way when she lost her job in 2020. Her federal loans offered forbearance and income-driven options, while her private lender offered a brief payment pause with interest still accumulating. Check each loan's interest rate, servicer, and repayment status. Some borrowers have loans scattered across multiple servicers without realizing it. Mark discovered he had 3 different loan servicers and had been missing opportunities for consolidation that could have simplified his payments and potentially reduced his rates. Understanding these distinctions isn't just paperwork busywork. It's the foundation for every smart decision you'll make about repayment, forgiveness programs, and refinancing. Get this wrong, and you might accidentally forfeit thousands in potential savings or protections you didn't know you had. Part 2. Evaluating repayment plans and options. The federal government offers several repayment plans because they understand that one size doesn't fit all when it comes to student loans. Think of these plans like choosing the right pair of shoes for different occasions. What works for a casual walk won't work for a marathon. The standard repayment plan is like the basic black shoe of student loans. You pay fixed monthly amounts over 10 years, and you're done. Sarah, a marketing coordinator earning $45,000, chose this plan because she wanted predictability. Her $350 monthly payment hurt at first, but she appreciated knowing exactly when her debt would disappear and how much interest she'd pay total. Income-driven repayment plans work differently. They calculate your payment based on your income and family size, not your loan balance. These plans, income-based repayment, pay as you earn, and income contingent repayment can dramatically reduce monthly payments for struggling borrowers. When Jake lost his job in 2020, his payment dropped from $600 to $0 under an income-driven plan, giving him breathing room during unemployment. The trade-off seems obvious but catches many people off guard. Lower monthly payments mean more interest accumulates over time. Jake's eventual forgiveness after 20 years came with a tax bill on the forgiven amount that he hadn't anticipated. Graduated repayment starts with lower payments that increase every 2 years. This appeals to recent graduates expecting salary growth, but the math rarely works out favorably. Extended repayment stretches payments over 25 years with lower monthly amounts but significantly higher total interest costs. Here's where it gets tricky. Life changes should trigger plan reviews. Marriage can dramatically affect income-driven payment calculations, sometimes doubling payments overnight when spouse income gets factored in. Having children might lower them again. Career changes, salary increases, or financial emergencies all warrant reassessment. The key question isn't which plan sounds best on paper. It's which plan aligns with your current reality and future goals. Can you handle higher payments now to save money long-term? Do you qualify for loan forgiveness programs that make income-driven plans more attractive? Are you prioritizing cash flow for other financial goals like emergency funds or retirement savings? Most borrowers can switch repayment plans annually, but some changes are irreversible. Understanding these nuances before committing prevents costly mistakes that could follow you for decades. Part 3. Navigating refinancing and consolidation decisions. Many borrowers confuse loan consolidation with refinancing, often making decisions that cost them thousands in protections and savings opportunities. Federal loan consolidation works differently than private refinancing, though both promise to simplify your monthly payments. When you consolidate federal loans through the Department of Education, you combine multiple federal loans into one new federal loan. The interest rate becomes a weighted average of your existing rates, rounded up to the nearest 1/8%. You keep all federal protections like income-driven repayment plans, forbearance options, and forgiveness eligibility. Private refinancing operates like getting a completely new loan from a bank or online lender. Companies like SoFi, Earnest, or Citizens Bank pay off your existing loans and issue you a fresh private loan with new terms. Your federal loans become private loans, permanently losing all federal protections. This trade happens even if you only had federal loans before refinancing. Consider Sarah, a nurse practitioner earning $85,000 annually. She had $120,000 in federal loans at 6.8% interest. A private lender offered her a 4.2% rate, potentially saving $15,000 over 10 years. But Sarah worked at a qualifying nonprofit hospital, making her eligible for public service loan forgiveness after 10 years of payments. By refinancing, she would forfeit potential forgiveness of her remaining loan balance, potentially $70,000 or more. The interest savings paled compared to the forgiveness opportunity she abandoned. Private refinancing makes sense for specific borrowers. High earners with stable income and excellent credit often secure significantly lower rates than federal loans offer. Marcus, a software engineer earning $140,000, refinanced $80,000 in graduate school loans from 7.2% to 3.1%. He had no interest in income-driven plans or forgiveness programs, preferring the lower rate and aggressive payoff timeline. Borrowers with existing private loans face simpler decisions. Private loans lack federal protections anyway, so refinancing only involves comparing interest rates and terms between lenders. Multiple refinancing rounds can make sense as credit scores improve or market rates drop. Evaluate your situation honestly before deciding. Do you work in public service or plan to pursue qualifying employment? Are your current federal loan payments manageable, or do you need income-driven flexibility? Could job loss or income reduction require forbearance options? Would losing forgiveness eligibility devastate your financial plan? Calculate the break-even point where interest savings exceed lost protection value. Factor in your career stability, industry outlook, and personal risk tolerance. Remember that refinancing decisions cannot be reversed. Once federal loans become private, they stay private forever. Part 4. Exploring forgiveness programs and strategic payoff. Public service loan forgiveness sounds almost too good to be true. Work for a qualifying employer for 10 years, make 120 qualifying payments, and watch your remaining federal loan balance disappear. The program launched in 2007, meaning the first wave of applicants became eligible in 2017. Unfortunately, the initial approval rates were brutal. Less than 2% of applicants received forgiveness in those early years. Why such dismal numbers? Most rejections stemmed from simple mistakes that applicants discovered too late. Sarah worked as a social worker for a nonprofit organization for 8 years before learning her loan servicer had placed her in the wrong repayment plan. None of her payments counted toward PSLF requirements. She had to start the 120 payment clock over again. This scenario played out for thousands of borrowers who assumed any payment on federal loans would count. PSLF requires federal direct loans, not FFEL or Perkins loans. Your employer must qualify as a 501c3 nonprofit or government entity. You need an income-driven repayment plan. Standard repayment also qualifies, but most people pursuing forgiveness want lower monthly payments. Every year, submit the employment certification form to verify your employer still qualifies and track your progress. Teacher loan forgiveness offers up to $17,500 in forgiveness after 5 consecutive years teaching in qualifying low-income schools. Unlike PSLF, you can use this program once per borrower. Math, science, and special education teachers in secondary schools can receive the full $17,500, while other teachers receive up to $5,000. Here's where strategy matters. You cannot combine teacher loan forgiveness with PSLF for the same teaching period. If you plan a long public service career, PSLF might offer bigger benefits since it forgives your entire remaining balance. Income-driven repayment plans also offer forgiveness after 20 to 25 years of payments, but you'll owe taxes on the forgiven amount. This creates a potential tax bomb that many borrowers ignore when calculating benefits. What if forgiveness programs don't apply to your situation? The math becomes more personal. David had $40,000 in student loans at 4% interest. He could make minimum payments and invest extra money in index funds, potentially earning 7 to 8% returns over time. The math favored investing, but David lost sleep thinking about his debt every night. He chose aggressive payoff for psychological peace, understanding he sacrificed potential investment gains for mental clarity. Your decision should consider interest rates, investment timeline, job security, and emotional relationship with debt. There's no universally right answer, only what works for your specific circumstances and sleep patterns. Chapter 8. I've got debt, so why should I care about saving? Part 1. The psychological benefits of saving while in debt. Your stressed brain makes terrible money decisions when it knows you're completely broke. When Rachel from Cleveland had $32,000 in student loans but managed to save her first $500, something unexpected happened. The debt hadn't shrunk, but her sleep improved dramatically. She stopped checking her bank account with the same anxiety she once felt looking at horror movies. That small cushion transformed her relationship with money, despite owing exactly the same amount the day before. Financial stress floods your system with cortisol, the same hormone released when being chased by a bear. Your rational brain shuts down, while your survival instincts take over. This explains why people with zero savings make increasingly desperate choices. Borrowing from credit cards for car repairs, taking payday loans for medical bills, or accepting terrible job conditions because they can't afford to quit. The Mayo Clinic found that financial stress ranks higher than work pressure or relationship problems as a source of anxiety. When researchers at UCLA studied brain scans of people thinking about their finances, those with emergency funds showed significantly less activity in the brain's fear center compared to those living paycheck to paycheck. Your brain literally processes money differently when it knows backup exists. Sarah, a teacher in Portland, discovered this firsthand. While carrying $28,000 in credit card debt, she saved $1,200 over 8 months. Mathematically, that money could have reduced her debt balance and saved interest payments. Psychologically, it gave her the confidence to negotiate a raise she'd been avoiding for 2 years. The additional income exceeded what she would have saved in interest payments. This phenomenon explains why Dave Ramsey's famous advice to save $1,000 before aggressive debt payoff works despite seeming mathematically backwards. That small buffer stops the cycle of creating new debt every time life happens. When your car needs repairs, you use savings instead of credit cards. When medical bills arrive, you have options beyond payment plans. Building savings while in debt also develops crucial muscle memory. The habits you create during challenging financial periods become automatic behaviors that persist after your debt disappears. People who learn to save while struggling typically continue saving when their income increases, while those who wait until debt freedom often find lifestyle inflation consuming their newly available money. Your mental health affects every financial decision. A mind consumed by money stress makes choices that perpetuate financial problems. Sometimes protecting your psychological well-being creates better long-term outcomes than pure mathematical optimization. Part 2. Building an emergency fund while paying off debt. Here's the practical truth about emergency funds. Your car doesn't care about your credit card debt when the transmission fails on Tuesday morning. Neither does your water heater, your cat needing surgery, or your employer deciding to downsize your department. These situations happen with frustrating regularity, and they require immediate cash solutions. Most people in debt assume their credit cards function as emergency funds. This thinking creates a dangerous trap. When emergencies strike, you're forced to increase debt balances, which extends payoff timelines and increases interest costs. Sarah, the teacher from Portland, learned this lesson when her apartment's heating system broke in January. Her landlord demanded immediate repair payment, and she added $1,200 to already maxed credit cards. What should have been a manageable emergency became months of additional debt payments. Building a starter emergency fund means targeting $1,000 or 1 month of essential expenses, whichever feels more realistic for your situation. This isn't about perfection. It's about creating breathing room between you and financial disaster. The strategy requires temporary adjustment to your debt payment approach. Instead of sending every available dollar toward debt balances, redirect $50 to $100 monthly toward emergency savings. Yes, this extends your debt payoff timeline by a few months, but consider the alternative. One major emergency could extend your debt journey by years. Use windfalls strategically. Tax refunds, birthday money, overtime pay, or that $20 you found in last winter's coat pocket all go toward emergency savings until you reach your target amount. Marcus, an accounting clerk from Chicago, built his $1,000 emergency fund in 8 months by redirecting his monthly parking reimbursement and occasional freelance income. Look for small amounts to shift from non-essential spending. This doesn't mean eliminating all enjoyment from your budget. Instead, find $5 here and $10 there from categories like dining out, subscriptions, or impulse purchases. These tiny redirections add up surprisingly quickly. Your emergency fund should live in a separate savings account, preferably at a different bank from your checking account. This creates just enough friction to prevent casual spending while keeping funds accessible during genuine emergencies. The goal isn't earning interest or investment returns. The goal is having cash available when life inevitably presents unexpected expenses. Remember that building this fund develops crucial financial habits. You're training yourself to save consistently, even when competing priorities demand your money. These skills become invaluable once your debt disappears and larger wealth-building opportunities emerge. Part 3. The concept of paying yourself first. Most people think paying yourself first means waiting until all bills are paid, then saving whatever remains. Warren Buffett proved this backwards when he became the world's 3rd richest person by reversing this formula completely. The concept sounds counterintuitive when you're drowning in student loans or credit card debt. Why save money earning 2% interest when you could eliminate debt charging 18%? The math seems obvious, but human behavior rarely follows mathematical logic. Paying yourself first means automatically moving money to savings the moment your paycheck arrives, before rent, groceries, or debt payments. This isn't about optimizing interest rates. This is about rewiring your financial brain to prioritize future wealth over immediate consumption. Consider Sarah, a 26-year-old teacher with $30,000 in student loans. Instead of throwing every extra penny at debt, she automatically transfers $50 from each biweekly paycheck into savings. That's only $1,300 annually, but the habit transforms her relationship with money entirely. The magic happens in your checking account balance. When you pay yourself first, you naturally spend less on everything else. Your brain adapts to living on the remaining money rather than the full paycheck amount. This artificial scarcity forces better spending decisions without requiring constant willpower. Start ridiculously small to avoid overwhelming your budget. Even $25 per paycheck builds the neural pathways that separate wealthy people from everyone else. Wealthy individuals save first, then figure out how to live on what remains. Everyone else saves last, if at all. Timing matters more than amount. Schedule automatic transfers for the same day your paycheck deposits, ideally within hours. This prevents the money from mixing with spending funds and reduces the temptation to skip saving when unexpected expenses arise. Your savings percentage can increase as you eliminate debt payments. When that car loan disappears, redirect the entire payment to savings rather than lifestyle upgrades. This prevents lifestyle inflation from consuming your newfound financial freedom. The discipline you develop while balancing debt payments and savings creates financial muscles that strengthen over time. These habits persist long after debt disappears, ensuring that increased income translates to increased wealth rather than increased spending. Most people who eliminate debt without developing savings habits simply replace old debt with new purchases. Part 4. Balancing debt payoff, savings, and quality of life. Picture yourself as a pressure cooker ready to explode from financial stress, while every financial guru screams, "Cut everything fun." The biggest mistake young people make when tackling debt isn't mathematical, it's psychological. They adopt extreme deprivation strategies that work for 3 months before spectacular failure. Consider Sarah, a marketing coordinator who eliminated all entertainment spending to attack her student loans. By month 4, she binged on a weekend shopping spree that added $800 to her credit card debt. Her all-or-nothing approach backfired because humans aren't machines programmed for endless sacrifice. Real sustainable progress requires acknowledging that you're still living your life while improving it. Netflix subscriptions and monthly dinners with friends aren't luxuries, they're sanity preservers. The goal isn't becoming a financial monk, but creating breathing room within your constraints. Start by listing everything you spend money on besides basic needs like housing, food, and minimum debt payments. Now, categorize these expenses into absolutely necessary for my mental health versus nice but not essential. That weekly coffee with your coworker who keeps you sane probably stays. The premium cable package you rarely watch? Easy cut. Research from behavioral economists shows that people who maintain small pleasures during debt payoff stick to their plans 73% longer than those practicing total deprivation. Your brain needs positive reinforcement to maintain difficult behaviors over time. Complete restriction creates resentment toward your financial goals rather than motivation. The 50-30-20 rule needs modification when debt dominates your finances. Instead, try 50% for needs, 20% for debt payment, 15% for minimum fund money, 10% for emergency savings, and 5% for flexibility. This prevents the feast or famine cycle that destroys financial progress. Quality of life doesn't require expensive habits. Free hiking, library books, cooking elaborate meals at home, and hosting potluck dinners create enjoyment without derailing progress. The key is conscious choice rather than mindless restriction. Your 20s and 30s shouldn't feel like financial prison sentences. Debt payoff works best when it fits around your actual human needs for connection, entertainment, and small indulgences. Balance prevents the burnout that leads to abandoning your financial plan entirely. Progress matters more than perfection, and sustainable habits beat extreme measures every time. Chapter 9. I can't afford to split this dinner bill evenly. Part 1. Why money conversations with friends are so awkward. Your stomach churns when the dinner check arrives and someone cheerfully announces they'll split it evenly among 8 people. This reaction isn't unique to you. Americans learn early that discussing money feels more uncomfortable than talking about politics, religion, or even personal relationships. Brad Clantz's research at Kansas State University found that 43% of Americans would rather discuss their deepest fears than reveal their salary to friends. This silence creates a peculiar social dynamic where we'll share intimate details about our dating lives but freeze when asked about our student loan payments. The discomfort runs deeper than simple privacy preferences. Money conversations trigger what psychologists call social comparison theory. When friends discuss finances, we automatically measure our situations against theirs. Sarah, a marketing coordinator in Denver, discovered this firsthand when her college roommate casually mentioned maxing out her 401k at age 25. "I felt like a complete failure," Sarah recalls. "I was proud of my $50 monthly contribution until that moment." Society teaches us that financial struggles reflect personal shortcomings rather than systemic realities. When rent consumes 40% of your income while your friend's parents helped with their down payment, admitting you can't afford weekend trips feels like confessing inadequacy. This shame spiral prevents honest discussions that could actually help both parties. The silence compounds financial problems rather than protecting relationships. When friends don't communicate budget constraints, they end up in expensive situations that breed resentment. Jessica Chen, a teacher in Portland, accumulated $800 in credit card debt trying to keep pace with friends' restaurant choices before finally admitting her budget limitations. "I was angry at them for suggesting expensive places, but they had no idea I was struggling," she reflects. Different financial situations among friends represent normal life circumstances, not moral judgments. Your friend with the tech job isn't superior because they can afford $200 dinners, any more than you're inferior for choosing $20 alternatives. These variations reflect career timing, family backgrounds, and countless factors beyond individual control. Avoiding money conversations damages relationships more than addressing them directly. Friends who truly care about your well-being want you to succeed financially, not sacrifice your future for temporary social moments. Those who pressure you to overspend after learning your constraints reveal their priorities don't align with your best interests. Money silence creates artificial barriers between people who otherwise share genuine connections. Breaking this pattern requires courage, but preserves both financial health and authentic friendships. Part 2. Scripts for declining expensive social invitations. Learning these scripts beforehand prevents the stumbling and awkward pauses that make declining invitations feel more uncomfortable than necessary. When Sarah's coworkers invited her to a $150 wine tasting during her debt payoff year, she had practiced exactly what to say. "That sounds really fun, but it's not in my budget right now. What about checking out that new coffee place instead?" The invitation got redirected. Friendships stayed intact, and her debt payoff timeline remained on track. The direct budget mention works well when you're comfortable being open about money. "I'd love to join you, but that's outside my budget this month," requires no explanation beyond the simple truth. This approach often prompts friends to suggest less expensive alternatives without you having to ask. When Netflix product manager Rachel Cruz tested this approach with her friend group, she discovered half of them thought the same way about expensive outings but hadn't spoken up. For those less comfortable discussing money directly, focus on the activity rather than cost. "I'm not really in the mood for a big dinner out, but I'd love to hang out. Want to grab coffee instead?" shifts attention away from financial constraints while still declining the original invitation. This approach works particularly well for spontaneous invitations where budget wasn't the only consideration. When friends persist after your initial decline, hold your ground without over-explaining. "Thanks for thinking of me, but I really can't make it work," should end the conversation. Friends who continue pushing after clear communication either don't understand boundaries or don't respect them. Old situations reveal important information about the relationship dynamic. Group text invitations require slightly different strategies. Suggest alternatives publicly. "That restaurant looks amazing, but pricey. What about trying that new taco place instead?" This approach often reveals that others share your budget concerns but waited for someone else to speak first. Restaurant industry data shows 68% of diners regularly choose restaurants based on price. Yet most people assume they're alone in having budget constraints. The key lies in offering solutions rather than just declining. "I can't do the wine tour, but I could host a potluck that night if people want to hang out," maintains your role as someone who initiates social activities rather than just declining them. This proactive approach preserves your position within the friend group while respecting your financial boundaries. Remember that good friends want you to succeed financially more than they want you at every expensive event. Those who consistently pressure you to overspend after learning your situation prioritize their convenience over your well-being. Protecting your budget from social pressure isn't selfish. It's essential for achieving the financial stability that benefits all your relationships long-term. Part 3. Suggesting alternative activities that fit your budget. Your cheapest friend often becomes the most creative social planner once they stop apologizing for their budget constraints. Erin Lowry transformed her financial limitations into a superpower for building stronger friendships through activities that cost practically nothing but delivered experiences people still talk about years later. Consider Sarah, a marketing coordinator in Chicago who started Broke Brunch when restaurant bills hit $60 per person. She invited friends to her tiny apartment every Sunday, asking each person to bring one dish. The potluck grew from 4 friends to 12 regulars who now refer to those gatherings as the highlight of their 20s. The food was better, conversations lasted hours longer, and nobody worried about impressing servers or splitting complex bills. Free events require zero shame when presented as discoveries rather than budget alternatives. Museums offer free resident days, cities host outdoor concerts, and hiking trails cost nothing but gas money. Jessica Chen, a teacher in Portland, became known as the Fun Finder after researching free weekend activities. Her friend group nicknamed her their Adventure Coordinator because she consistently discovered events they never would have found otherwise. Happy Hour transforms expensive dinner dynamics entirely. Meeting at 4 o'clock for appetizers and drinks costs half the price of full dinners, while offering the same social connection. Many restaurants offer significant discounts during slower hours, making the same venue affordable when timing shifts slightly. The key lies in presentation and enthusiasm rather than explanation. I found this amazing food truck festival Saturday afternoon. Sounds more appealing than I can't afford dinner, so let's do something cheaper. Frame alternatives as exciting discoveries rather than financial compromises. Most people appreciate creative options when presented confidently. Hosting house parties for specific events creates traditions that friends request repeatedly. Game nights, movie marathons, or seasonal celebrations cost less than single restaurant meals but build stronger memories through personal touches impossible in commercial venues. Weather permitting, outdoor activities offer endless free entertainment. Beach days, park picnics, or neighborhood walks encourage longer conversations without time pressure from servers or other patrons. Nature provides better backgrounds for connection than crowded restaurants anyway. Budget creativity often produces better experiences than expensive defaults. When financial constraints force you to think beyond standard dinner and drinks patterns, you discover activities that actually suit your friend group's interests rather than defaulting to convenient but generic options that everyone tolerates but nobody loves. Part 4. Handling split bills and shared expenses. The check arrives at your table and suddenly everyone reaches for their phones to calculate their share. But Sarah ordered 2 cocktails and an appetizer while you had water and a salad. Picture this scenario that plays out in restaurants across America every weekend. You're celebrating a friend's promotion at an upscale steakhouse. While others order ribeyes and multiple rounds of drinks, you stick to a modest chicken dish and water, knowing your monthly dining budget is already stretched thin. When the bill comes, someone cheerfully announces, "Let's just split it evenly." Your stomach drops as you realize you're about to pay $60 for a $30 meal. This exact situation happened to marketing coordinator Jessica Chen in San Francisco. After repeatedly paying double what she ordered to avoid seeming cheap, she calculated she had overspent her food budget by $400 in 3 months. The revelation prompted her to develop a simple strategy that saved both money and friendships. The key lies in timing your approach before anyone orders. When you arrive at the restaurant, casually mention to the group, I'm watching my spending this month, so I'll probably pay for just what I order separately. Most people appreciate the heads up, and often others quietly feel relieved to do the same. Payment apps like Venmo and Splitwise have revolutionized bill splitting by making exact calculations normal rather than awkward. Instead of complex mental math at the table, one person pays the full bill and sends itemized requests later. This method removes the social pressure and allows everyone to pay precisely what they owe without public negotiation. Cultural backgrounds significantly influence bill splitting expectations. Many European friends expect separate checks as standard practice, while some American groups default to even splits regardless of individual orders. Understanding your group's tendencies helps you prepare appropriate strategies. Sometimes absorbing small overcharges makes sense for relationship harmony. If you ordered items totaling $22 and the even split comes to $25, the $3 difference might not justify potential awkwardness. However, when the gap reaches $10 or more, speaking up protects your financial goals without compromising your values. The restaurant industry has adapted to these preferences. Many establishments now automatically provide separate checks when requested early in the meal, and servers often ask about payment preferences before taking orders. This normalization removes much of the stigma around requesting fair splits. Financial responsibility requires advocating for yourself in social situations. Your budget boundaries matter more than temporary discomfort from addressing payment inequity. Chapter 10. Getting financially naked with your partner. Part 1. Why financial compatibility matters for relationships. Money fights destroy more relationships than cheating, according to research from the American Psychological Association. When Marcus and Sarah started dating, they avoided talking about money for 8 months. Both earned decent salaries and split restaurant bills easily. Everything seemed perfect until Marcus discovered Sarah had $45,000 in credit card debt during their apartment hunt. The relationship ended within 2 weeks. Sarah felt judged and ashamed. Marcus felt deceived and questioned what else she might be hiding. Their story reflects a pattern researchers see repeatedly. A Kansas State University study found that couples who argue about money weekly are 30% more likely to divorce than those who rarely discuss finances. But here's what surprised researchers. The frequency of money fights mattered more than income levels or debt amounts. Financial compatibility doesn't mean earning identical paychecks. It means sharing similar values about spending, saving, and financial priorities. Consider Rachel and David, who married despite earning vastly different incomes. Rachel made $35,000 as a teacher, while David earned $95,000 in tech. Their relationship thrived because both valued saving for experiences over buying expensive items. They agreed on priorities: travel together, save for a house, and avoid credit card debt. Contrast this with Jennifer and Mike, both lawyers earning similar six-figure salaries. Jennifer saved aggressively for retirement and emergencies. Mike preferred spending on luxury cars and expensive dinners. Despite their financial equality, constant tension emerged over every purchase decision. They divorced after 3 years. Financial secrets create relationship problems that extend far beyond money. When partners hide purchases, debt, or financial fears, they damage trust in ways that affect communication about everything. Dr. Brad Klotz's research shows that financial infidelity, hiding money matters from partners, occurs in 30% of marriages and often predicts eventual separation. The solution isn't avoiding money conversations, but having them early and regularly. Think about it. You wouldn't marry someone without discussing whether you want children or where you want to live. Money deserves the same attention because financial stress affects daily life more than almost any other relationship factor. Smart couples treat money talks like relationship maintenance, similar to discussing career goals or family plans. They recognize that comfort discussing finances indicates healthy communication skills that benefit every aspect of their partnership. The goal isn't eliminating all financial disagreements, but developing tools to handle them constructively. Money conversations feel uncomfortable because society teaches us that discussing finances is rude or private. But successful relationships require breaking through this cultural barrier. The alternative, discovering fundamental financial incompatibilities after marriage or children, creates complications that extend far beyond awkward conversations. Part 2. When and how to have the first money talk. Most couples wait too long before having their first serious money conversation, often after they've already moved in together. The sweet spot for financial disclosure falls somewhere between exclusivity and major life decisions. Dating expert Helen Fisher found that couples who discuss finances within 6 months of becoming exclusive report higher relationship satisfaction 5 years later. This timing makes sense because you've established emotional intimacy but haven't yet intertwined your lives financially through shared leases, joint purchases, or marriage planning. Think of this conversation like planning a road trip together. You wouldn't drive across the country without discussing the route, budget, and who's paying for gas. Similarly, building a relationship requires understanding each other's financial starting points and destinations. Start the conversation casually, perhaps during a quiet dinner at home. Avoid ambushing your partner right after a stressful day or during a romantic evening. Many successful couples begin with simple questions like, "How did your family handle money when you were growing up?" This approach feels less threatening than immediately asking about debt or income. Structure the discussion around 4 key areas: past money experiences, current financial reality, attitudes towards spending and saving, and future financial dreams. Rachel from Portland learned this the hard way when she discovered her boyfriend had $40,000 in credit card debt after they'd already signed a lease together. "I wish we'd talked about it 6 months earlier when it would have been a conversation starter, not a relationship crisis," she reflects. Frame past financial mistakes as learning experiences rather than character flaws. When sharing your own money history, explain what you learned from previous decisions. This modeling encourages honesty from your partner. Instead of saying, "I was terrible with money," try, "I learned a lot about budgeting after accumulating some debt in college." Pay attention to how your partner responds to these topics. Do they become defensive or shut down when discussing money? Can they acknowledge past mistakes without making excuses? Someone who blames everyone else for their financial problems or refuses to engage in money conversations reveals important information about their communication style and personal responsibility. The goal isn't achieving perfect financial alignment, but establishing whether you can work through differences together. Part 3. Merging finances, joint, separate, or hybrid approaches. Once you've established open communication about money, the next question becomes practical. How should you actually manage finances together? This decision affects everything from daily spending to long-term savings, and there's no universal right answer. Netflix CEO Reed Hastings and his wife Patty Quillen maintain completely separate finances despite their substantial wealth. They each handle their own investments, charitable giving, and personal expenses. Meanwhile, financial expert David Bach and his wife Jean merge everything into joint accounts, believing shared money creates stronger partnership alignment. Both approaches work because they match each couple's personalities and values. The fully merged approach combines all income, expenses, and accounts. This system works well for couples who view marriage as complete financial partnership and prefer simplified money management. When both partners earn similar amounts and share spending philosophies, merged finances eliminate the mental accounting of yours, mine, and ours. Research from Kansas State University found that couples with joint accounts report feeling more satisfied with their relationships and more committed to shared goals. However, merging everything can create friction when partners have vastly different incomes or spending habits. The higher earner might feel controlled when questioned about purchases, while the lower earner might feel guilty spending shared money on personal interests. Completely separate finances give each partner maximum autonomy. This approach appeals to couples who value financial independence or have significantly different spending philosophies. Late-night online shopping sprees don't require explanations, and each person maintains full control over their earning and spending decisions. The challenge with separate systems involves splitting shared expenses fairly. Do you divide the mortgage equally or proportionally based on income? Who pays for groceries this week? These administrative details can create ongoing negotiations that some couples find exhausting. The hybrid approach combines joint accounts for shared expenses with individual accounts for personal spending. Many couples find this balance provides teamwork benefits while preserving individual autonomy. You might contribute proportionally to joint accounts covering housing, utilities, and groceries, while keeping separate accounts for hobbies, gifts, and personal purchases. The key lies in matching your system to your relationship dynamics, rather than copying what works for others. Consider your income differences, administrative preferences, and need for financial independence. What matters most is choosing an approach you can both commit to and adjusting it as your circumstances change. Part 4. Navigating financial conflicts and different money styles. Money fights hit different when you realize they're rarely about the actual money at all. When Sarah discovered her boyfriend Jake had blown their vacation fund on a gaming setup, the explosion that followed revealed layers they'd never discussed. She valued security and planning ahead, while he believed in enjoying money when you have it. Their argument wasn't really about the PlayStation. It was about fundamentally different approaches to life itself. Understanding your money personality becomes crucial once you're sharing financial decisions. Research from Kansas State University found that couples who argue about money weekly are 30 times more likely to divorce than those who rarely fight about finances. The difference often comes down to recognizing and working with personality differences rather than fighting against them. Think of money personalities like different languages. Spenders speak fluently about experiences and opportunities, while savers converse in terms of security and future planning. Planners organize everything into spreadsheets and categories, while spontaneous personalities see rigid budgets as creativity killers. Neither approach is wrong, but miscommunication creates chaos. The real breakthrough happens when couples stop trying to change each other and start building bridges. Jake and Sarah eventually created what they called fun money accounts, equal amounts each month that either could spend without discussion or judgment. Sarah could save hers for 3 months to buy quality hiking boots, while Jake could impulse buy concert tickets. Their shared goals remained protected, but individual personalities got breathing room. Regular money dates transform conflicts into conversations. Choose a relaxed time monthly to discuss finances without laptops or phones. Start with wins: bills paid on time, savings goals met, smart purchases made. Address concerns calmly, focusing on solutions rather than blame. When disagreements arise, dig deeper into underlying values. Why does overspending trigger anxiety? What does financial freedom actually mean to each person? Creating shared goals that excite both personalities requires creativity. Instead of arguing about restaurant spending, plan together for a cooking class vacation. Rather than fighting about shopping habits, establish a dream house fund that motivates saving while allowing current enjoyment. The couples who succeed financially don't eliminate differences. They learn to make those differences work together. A planner married to a spontaneous personality often creates the perfect balance of security and adventure, provided both feel heard and valued in financial decisions. Financial intimacy grows through consistent, honest communication about fears, dreams, and values. Money becomes a tool for building the life you both want, rather than a weapon for proving who's right. Chapter 11. Paying rent to your rents. Living at home after college. Part 1. Reframing living at home as a financial strategy. Your Instagram feed shows friends in trendy apartments while you're back in your childhood bedroom, questioning every life choice. Living with parents after college feels like admitting defeat. The comments from relatives at family gatherings sting. Your dating life suffers when you have to explain your living situation. These feelings are real and completely valid, but they're also preventing you from seeing the massive financial advantage you might be sitting on. Consider Sarah from Portland, who moved back home after graduation in 2019 with $45,000 in student loans. While her friends spent $1,200 monthly on rent, she lived with her parents for 2 years. That saved money went straight to loan payments. She eliminated her entire debt burden by age 24. Her friends? Still paying minimum payments on loans that will stretch into their 30s. The numbers tell a story that contradicts social expectations. A 2022 Pew Research study found that 25% of adults aged 25 to 34 live with parents, up from 12% in 1980. Economic reality trumps social pressure when you're facing $30,000 average student debt alongside entry-level salaries that barely cover basic living expenses. Living at home isn't failure when it serves a clear financial purpose. The key difference lies in intention versus default. Are you there because it's easy or because you're executing a specific financial strategy? Marcus, a graphic designer from Chicago, moved home with a goal to save $20,000 for a down payment. He set a 2-year timeline and tracked progress monthly. This wasn't regression, it was strategic planning. Your emotional comfort matters, but so does your financial future. The shame you feel about living at home pales compared to the stress of carrying debt for decades or struggling paycheck to paycheck in an overpriced apartment. Think of your parents' house as temporary headquarters for financial reconstruction, not a permanent retreat from adult responsibility. The decision requires honest assessment of your specific situation. Consider your debt load, local rental costs, job prospects, and family dynamics. If staying home lets you eliminate $500 monthly student loan payments 2 years faster, you're essentially earning $500 monthly tax-free. Few investments offer those guaranteed returns. Smart money management sometimes requires short-term social discomfort for long-term financial freedom. The friends judging your living situation today will envy your debt-free status tomorrow. Part 2. Establishing boundaries and expectations with parents. The biggest mistakes happen in the first week back home, when nobody talks about what life looks like now that you're an adult living in your parents' space. Rachel moved back home after graduation and spent 3 months battling her mom about dirty dishes before realizing they never discussed who handles what anymore. Her parents expected her to contribute like an adult, but treated her like their teenage daughter. She felt frustrated. They felt disrespected, and nobody understood why something that seemed simple became so complicated. This confusion happens because everyone assumes they're on the same page without actually checking. Your parents remember you as someone who left clothes everywhere and stayed out until 2 a.m. You see yourself as a responsible adult who just happens to sleep in their old bedroom. Neither perspective is wrong, but both need updating. Treat this conversation like you would with any new roommate. You wouldn't move in with a friend and just assume they're cool with your habits or schedule. The same principle applies here, except the emotional history makes everything trickier. Start with the practical stuff first. Who buys groceries? Who cooks? When is the kitchen available? Can you eat their leftovers? These questions sound silly, but Maria's family fought for months because she kept eating her dad's special yogurt that he bought for his breakfast routine. One 5-minute conversation would have prevented weeks of passive-aggressive notes on the refrigerator. Privacy boundaries matter more than you think. Jeff's parents felt comfortable walking into his room to drop off laundry, just like they did when he was 16. But Jeff now needed space for work calls and personal conversations. They weren't trying to invade his privacy, they simply didn't realize things had changed. Social rules need explicit discussion too. Can you bring dates home? What about friends hanging out on weeknights? Do weekend gatherings need advance notice? Sarah's parents were fine with her boyfriend visiting, but wished she had asked before he started showing up 3 nights a week for dinner. The key insight here is that nobody's mind-reading skills improved while you were away at college. Your parents want to respect your adult status, but they need clear guidance about what that looks like in their house. You want to be treated like an adult, but you need to communicate like one first. Write down the major areas where expectations might differ. Schedule a family meeting to discuss them openly. It feels awkward initially, but it prevents months of unnecessary tension over easily resolved issues. Part 3. Contributing financially to the household. Just because your parents offered you their basement doesn't mean they expect you to live there for free like you're still 16 years old. The most awkward conversation you'll have as an adult child living at home revolves around money. Sarah Chen learned this the hard way when she moved back home after college in 2019. For 6 months, she contributed nothing financially while her parents covered all household expenses. The arrangement felt increasingly uncomfortable, especially when her mother made passive-aggressive comments about the grocery bill doubling. Sarah realized she was creating the exact dependent relationship she wanted to avoid. Determining how much to contribute starts with honest math. Calculate your monthly income after taxes. Then research local rental prices for similar accommodations. A studio apartment in Sarah's Chicago neighborhood cost $1,200 monthly, so she offered her parents $400 per month plus groceries. This represents roughly 1/3 of comparable housing costs while acknowledging the value of home-cooked meals, laundry facilities, and utilities. When parents refuse payment, many adult children make the mistake of dropping the subject entirely. This creates an unbalanced dynamic where you're receiving significant financial benefit without reciprocating. Instead, find alternative ways to contribute value. Take over specific recurring expenses like the internet bill, car insurance, or grocery shopping. Marcus Williams paid his parents' streaming services and handled all yard maintenance. Calculating his contributions equaled roughly $300 monthly in services and subscriptions. Your income level matters significantly in these calculations. If you're earning minimum wage, contributing $200 monthly might represent a meaningful sacrifice. If you're pulling in $4,000 monthly, offering $200 seems insulting to everyone involved. Financial advisor Suze Orman suggests contributing between 20 to 30% of your after-tax income toward household expenses when living with family. Some parents insist on no payment because they want to help you save money faster. Respect their generosity while maintaining your dignity by automatically transferring your would-be rent contribution into a separate savings account. When you eventually move out, use these accumulated funds to purchase a meaningful gift for your parents or contribute to a family vacation. This approach preserves the adult relationship dynamic while honoring their support. The goal isn't finding the cheapest possible living arrangement. It's maintaining adult relationships with your parents while achieving specific financial objectives that prepare you for independent living. Part 4. Using this time strategically with clear exit plans. You need a specific exit strategy before you get too comfortable, or you'll still be there when your parents retire. The biggest mistake people make when moving back home is treating it like an extended vacation instead of a focused mission. Netflix in your childhood bedroom feels amazing after months of stress about rent payments, but comfort becomes the enemy of progress. Without clear goals and deadlines, what starts as a 6-month plan to pay off credit cards turns into 3 years of vague intentions while your friends establish their own lives. Netflix CEO Reed Hastings famously lived with his parents for months after Stanford to save money while building his first company. He set specific financial targets and timeline constraints that forced him out the door. The difference between strategic temporary living and indefinite dependency lies entirely in having concrete numbers and dates written down. Start by calculating exactly what independence costs in your target area. Research actual apartment prices, not just rent, but security deposits, moving expenses, and monthly utilities. If you want your own place by next December, you need first month's rent, last month's rent, security deposit, and moving costs. For a $1,500 apartment, that's potentially $4,500 upfront plus $200 for a truck rental. Create separate savings accounts for each goal. Label them specifically: emergency fund, apartment move-out, student loan payoff. Watching these numbers grow each month maintains motivation better than dumping everything into one generic savings account where progress feels abstract. Set aggressive but realistic timelines. Research shows people accomplish goals faster when deadlines create urgency. If paying off $8,000 in credit card debt feels overwhelming, break it into monthly targets of $667 over 12 months. Miss a target month, and you'll feel the pressure immediately rather than drifting aimlessly. The comfort trap hits hardest around month 6. Your parents start cooking your favorite meals again, laundry becomes effortless, and spending money on entertainment feels justified since housing costs nothing. This is when people abandon their exit plans. Combat this by automating transfers to your goal-specific accounts on payday, before you can spend the money on unnecessary purchases. Track your progress visually. Create a simple chart showing debt decreasing and savings increasing. Behavioral economist Dan Ariely's research confirms that visual progress tracking increases follow-through rates significantly. When your move-out fund hits 75% of your target, start seriously apartment hunting to maintain momentum. Your temporary living situation should feel slightly uncomfortable, not like a permanent solution. That mild discomfort keeps you focused on the financial objectives that brought you home initially. Chapter 12: How to Negotiate Salary by Learning to Ask for What You Want. Part 1: Why Negotiation Matters More Than You Think. That 40% salary increase I negotiated early in my career will be worth over $2 million by the time I retire. And most people have no idea how much money they're leaving on the table. Let me break down what actually happens when you skip negotiation. Sarah gets offered $65,000 at her first job and accepts immediately, feeling grateful. Her friend Mike negotiates that same offer up to $75,000. Both receive standard 3% annual raises. By age 35, Sarah earns $87,000 while Mike makes $100,000. That $10,000 difference compounds every single year because raises get calculated on your base salary. The math gets even more brutal when you factor in retirement contributions. If both contribute 10% to their 401k, Mike saves $10,000 annually, while Sarah saves $8,700. Over 30 years of compound growth, that difference balloons to hundreds of thousands in retirement savings. Each negotiation affects every paycheck, bonus, and benefit calculation for the rest of your career. Yet most people, especially women and minorities, avoid negotiating entirely. They worry about seeming greedy or pushy. Some fear employers will rescind offers. Others convince themselves they should feel grateful for any opportunity. This mindset costs them enormous sums over their lifetime. Here's what hiring managers actually think. Companies budget for negotiation. When Facebook recruiter Sarah talked to me about their hiring process, she explained they typically offer 20 to 30% below their maximum budget, expecting candidates to negotiate up. Managers who don't hear negotiation attempts often question whether candidates understand their worth or will advocate for themselves in client situations. Reed Hastings, Netflix's co-founder, once said they lose respect for candidates who don't negotiate because it signals they might not push back on important business decisions either. Companies want employees who will fight for budgets, challenge ideas, and advocate for their teams. The confidence gap hits hardest here. Men negotiate salary 60% more often than women, according to Carnegie Mellon research. But when women do negotiate, they often face backlash for being too aggressive. This creates a catch-22 that keeps earnings gaps persistent. The solution isn't avoiding negotiation, it's learning to do it effectively. Think of negotiation as a business discussion, not begging. You're presenting market data about your value, not making emotional appeals about your needs. Companies expect this conversation. Not having it signals you either don't understand professional norms or don't value yourself appropriately. Your willingness to negotiate literally determines your financial future. Those few uncomfortable conversations will pay dividends for decades. Part 2. Researching your market value. Finding your market value requires detective work, not guesswork. Netflix's Patty McCord discovered this when she revamped their compensation strategy in 2001. Instead of relying on outdated salary surveys, she started calling competitors directly. Within 6 months, they found they were underpaying top performers by 30 to 40%. This revelation changed everything. Your research needs to cast a wide net. Start with websites like Glassdoor, Payscale, and Salary.com, but treat these as starting points. These platforms aggregate user-reported data, which means some numbers might be inflated or outdated. LinkedIn's Salary Insights feature offers more recent data, especially for tech and professional services roles. Industry reports provide the gold standard for accuracy. The Robert Half Salary Guide, Dice Tech Salary Report, and similar publications survey thousands of employers annually. These reports break down compensation by experience level, specific skills, and geographic markets. Many are available free through their websites or professional associations. Geographic differences matter enormously. A software engineer making $120,000 in Austin might earn $180,000 performing identical work in San Francisco. But cost of living calculators tell only part of the story. Research local market conditions through regional job boards and city-specific salary surveys. Company size creates another variable. Startups might offer lower base salaries but equity compensation. Mid-size companies often provide the best balance of salary and benefits. Large corporations typically offer highest base pay but slower advancement. Factor in total compensation, including health insurance, retirement matching, and stock options. Professional networks provide invaluable intelligence. Former colleagues who've switched companies often share salary information freely. Alumni groups from your university maintain informal compensation discussions. Professional associations host salary surveys exclusive to members. Approaching these conversations requires finesse. Instead of asking, "What do you make?" try, "I'm researching market rates for marketing managers with 5 years experience. What salary range would you expect for that role?" This frames the discussion around market data rather than personal finances. Social media groups offer anonymous information sharing. Reddit communities, like r/CS Career Questions, regularly discuss compensation packages. Industry-specific Facebook groups maintain salary spreadsheets where members contribute anonymously. Discord servers for professionals often feature compensation channels. Document everything in a spreadsheet. Include position titles, experience requirements, company sizes, locations, and total compensation packages. This creates a comprehensive picture of market rates and strengthens your negotiation position with concrete data rather than assumptions. Part 3. Preparing and executing your negotiation. After gathering market data, you need a clear game plan before any conversation begins. Think of negotiation preparation like studying for a major exam. You wouldn't walk in unprepared and hope for the best. Start by determining 3 crucial numbers. Your target salary represents your ideal outcome based on market research and value. Your acceptable range shows the lowest amount you'd consider taking while still feeling good about the decision. Your walkaway point marks the number below which you'll decline and continue searching elsewhere. When Netflix employees prepared for their annual reviews in 2019, many followed this 3-number strategy. Those who clearly defined these boundaries before conversations began reported feeling more confident and achieved better outcomes than colleagues who entered discussions without preparation. Practice your actual words out loud. Record yourself saying, "Based on my research and the value I bring through increasing social media engagement by 40%, I'm looking for a salary in the range of $65,000 to $70,000. This sounds dramatically different from "I really need more money to pay my student loans." The first approach connects compensation to business results, while the second makes your request about personal problems. Sarah Vermont, a career strategist, discovered this difference when coaching a marketing manager. Initially, the employee planned to mention mortgage payments and daycare costs. After practicing value-based language instead, she successfully negotiated a 15% increase by highlighting her project management skills and client retention improvements. Timing matters significantly. Avoid Monday mornings when your manager faces weekly chaos or Friday afternoons when attention shifts to weekend plans. Mid-week conversations typically receive more thoughtful consideration. Schedule discussions after completing successful projects when your contributions feel fresh and visible. Prepare responses to common objections. If budget constraints arise, you might say, "I understand budget limitations. Could we discuss a performance review in 6 months to revisit compensation?" This shows flexibility while maintaining momentum toward your goal. Write down your key points beforehand, but keep the actual conversation verbal initially. Email creates permanent records that might limit future discussions. However, always follow up in writing afterward, summarizing agreed-upon terms and timelines. Anticipate pushback without taking it personally. Managers often test commitment by raising obstacles. When Adobe restructured compensation bands, employees who prepared calm responses to initial rejections often succeeded in second attempts after demonstrating persistence and professionalism. Part 4. Negotiating beyond salary. When your manager responds with, "We can't budge on salary," that's often where the real negotiation begins. Smart professionals recognize that compensation extends far beyond your base pay. Think of your total package like a puzzle with multiple pieces that create your overall value. Netflix discovered this during their rapid expansion phase. When budget constraints prevented salary increases for certain roles, they began offering unlimited vacation time and substantial professional development budgets. Employees who pushed beyond initial salary rejections often secured packages worth thousands more than their original requests. Start by calculating what different benefits actually mean in dollars. An extra week of vacation equals roughly 2% of your annual salary. A flexible work arrangement might save you $3,000 yearly in commuting costs. Professional development budgets can boost your earning potential for years to come. When Spotify employees negotiated learning stipends instead of immediate raises, many used those funds for certifications that led to promotions within 18 months. Create a priority list before entering these conversations. Which benefits solve your biggest problems? A new parent might value flexible scheduling over a signing bonus. Someone with student debt might prefer immediate cash benefits. Early career professionals often benefit most from mentorship programs and conference attendance that accelerate their growth. Remember that different benefits come from different budget pools. While HR might freeze salaries, your direct manager may have discretion over training budgets or work arrangements. When Slack faced hiring freezes, managers still negotiated equipment stipends and co-working space allowances for remote workers. Performance review timing becomes particularly powerful here. Instead of waiting 12 months for your next raise opportunity, negotiate a 6-month check-in tied to specific accomplishments. Document these agreements carefully. A simple email stating, "Following our conversation, I'll take on the Johnson project with a performance review scheduled for February to discuss compensation adjustments," creates accountability. The key insight: negotiation isn't a one-time event that happens during hiring. It's an ongoing conversation throughout your career. Salesforce employees who regularly discuss their contributions and value during quarterly reviews tend to see faster compensation growth than those who wait for annual cycles. What specific benefits would solve your current challenges better than a small salary increase? Chapter 13. Investing. No, it isn't gambling. Part 1. Understanding why investing differs from gambling. Your grandmother probably never threw $20 bills into a casino slot machine expecting compound returns over 30 years. When Jennifer bought shares of Apple in 2010, she became a tiny owner of the company. Every iPhone sold, every App Store purchase, every iPad delivered to customers increased the value of her investment. She wasn't betting on random chance. She owned part of a business creating real products that people wanted to buy. This represents the fundamental difference between investing and gambling. Gambling involves wagering money on uncertain outcomes without any underlying value creation. When you play blackjack, no new wealth gets generated. One person's loss becomes another's gain, nothing more. Investing means purchasing ownership stakes in companies or assets that produce value over time. Amazon shareholders own pieces of a company that delivers millions of packages daily. Microsoft investors hold portions of a business that powers computers worldwide. These companies employ people, create products, and generate profits that benefit their owners. Warren Buffett demonstrated this principle perfectly. In 1988, he purchased Coca-Cola stock not because he hoped the share price would randomly increase, but because he recognized millions of people drink Coke every day across the globe. That consistent demand creates real value for shareholders. Historical data supports this approach. Between 1926 and 2020, the S&P 500 averaged annual returns of approximately 10%, despite experiencing numerous crashes, recessions, and market panics. Individual years varied wildly, but patient investors who stayed invested captured this long-term growth. Time dramatically reduces investment risk. During any single year, stock markets can decline significantly. However, there has never been a 20-year period where diversified stock investments lost money when accounting for inflation. The longer you stay invested, the more likely you are to experience positive returns. Individual stock picking does resemble gambling because single companies can fail completely. Remember Enron or Blockbuster? However, diversified index funds spread risk across hundreds or thousands of companies. Even if some businesses fail, others succeed and drive overall growth. Consider this comparison. Las Vegas casinos design games where the house maintains mathematical advantages. Over time, gamblers consistently lose money to the casino. Stock markets operate differently. Companies collectively work to increase their profits, creating wealth that benefits patient shareholders. You're not betting against the house. You're partnering with businesses focused on growth and profitability. This partnership requires patience and consistency, but history shows it rewards those who participate. Part 2. Basic investment concepts and terminology. When people hear stocks and bonds, many imagine Wall Street traders shouting numbers or complicated graphs that require advanced degrees to understand. The reality is much simpler. Think of stocks as buying tiny pieces of companies you already know. When you purchase Apple stock, you literally own a microscopic slice of that company. If Apple creates the next iPhone breakthrough and profits soar, your little piece becomes more valuable. You make money two ways: the stock price increases, called capital gains, or the company shares profits with stockholders through quarterly payments called dividends. Amazon rarely pays dividends because they reinvest profits into growth, while Coca-Cola has paid dividends for decades. Bonds work differently. You're essentially lending money to companies or governments. When you buy a bond, you're the bank. The borrower promises to pay you back with interest after a specific time period. Government bonds are considered safer because countries rarely disappear, but they typically pay lower interest rates than corporate bonds. Higher interest usually means higher risk that the borrower might not pay you back. Here's where things get interesting. Most people shouldn't pick individual stocks or bonds because that's extremely risky. What if you choose poorly? Enter mutual funds and index funds, which solve this problem brilliantly. Imagine pooling your money with thousands of other investors to buy hundreds of different stocks. That's exactly what mutual funds do. Professional managers decide which stocks to buy and sell. Index funds take a simpler approach. by automatically buying every stock in a specific list, like the S&P 500, which tracks America's largest companies. Exchange-traded funds, ETFs, work similarly to index funds, but trade like individual stocks throughout the day. You can buy and sell them instantly during market hours, while mutual funds only price once daily after markets close. Every investment product charges fees called expense ratios, expressed as percentages. A mutual fund charging 1% annually costs $10 per year for every $1,000 invested. Index funds typically charge much less, often under 0.1%, because they require no active management decisions. Asset allocation means spreading your money across different investment types. A 25-year-old might put 80% in stocks and 20% in bonds, while someone approaching retirement might reverse those percentages. This balance helps manage risk while pursuing growth. The beauty lies in simplicity. You don't need to understand complex financial models or predict market movements. Understanding these basic building blocks gives you the foundation to start investing confidently without getting overwhelmed by industry jargon that often intimidates beginners. Part 3. The power of compound interest and starting early. Einstein supposedly called compound interest the eighth wonder of the world, and once you see the math, you'll understand why this force can make or break your financial future. Think of compound interest as money-making babies. Your initial investment earns returns, and then those returns start earning returns too. It's like planting a tree that grows fruit, and then each piece of fruit plants new trees. The earlier you plant, the bigger your orchard becomes. Consider Sarah and Tom, both earning identical salaries. Sarah starts investing $200 monthly at age 25. Tom waits until 35 to begin investing the same amount. By age 65, Sarah has invested $96,000 total and accumulated roughly $525,000. Tom invested the same monthly amount but only contributed $72,000 total, ending with about $245,000. Sarah's 10-year head start resulted in $280,000 more money, despite contributing only $24,000 more. This isn't magic, it's mathematics. Those extra 10 years gave Sarah's money more time to compound. Her early contributions had 4 decades to grow, while Tom's early contributions only had 3 decades. Time becomes your greatest ally when building wealth. The most dangerous myth plaguing young investors is believing they need substantial sums before starting. This mindset costs thousands of dollars in lost compound growth. Starting with $50 monthly beats waiting 5 years to invest $300 monthly. The market doesn't care about your contribution size. It cares about time. Vanguard research shows that investors who consistently contribute small amounts outperform those trying to time perfect market entry points. Missing just 10 of the market's best days over a 20-year period cuts returns by roughly half. Nobody can predict these days, making consistent investing more profitable than attempting perfect timing. Many millennials postpone investing while building emergency funds or paying debt. While these goals matter, completely avoiding investing creates enormous opportunity costs. Even investing $25 monthly while tackling other financial priorities puts compound interest to work immediately. You can increase contributions later as income grows or debt disappears. The painful truth about waiting is mathematical. Every year you delay investing potentially costs decades of compound growth. A 25-year-old investing $100 monthly for 40 years accumulates more wealth than a 35-year-old investing $200 monthly for 30 years. Starting small immediately beats waiting to start big later. Your future self will thank you for beginning today, regardless of the amount. Compound interest rewards patience and persistence, not perfection or large initial investments. Part 4. Getting started with investment accounts. Opening your first investment account feels overwhelming until you break it down into simple steps. Most people stare at endless account types and complex forms, then give up before starting. The reality is much simpler than financial companies make it appear. Start with what your employer offers. If your company provides a 401k with matching contributions, this becomes your first priority. Think of employer matching as free money sitting on the table. When Starbucks matches 50 cents for every dollar you contribute up to 6% of your salary, you earn an immediate 50% return before any market gains. Contact HR today to enroll. Many companies now automatically enroll new employees, but you control contribution amounts. Traditional IRAs and Roth IRAs serve different purposes based on your current situation. Traditional IRAs reduce your taxes today, but require paying taxes when you withdraw money in retirement. Roth IRAs use money you already paid taxes on, letting future withdrawals come out tax-free. If you earn under $40,000 annually, Roth IRAs usually make more sense because you likely pay lower tax rates now than you will in retirement. Most major brokerages eliminated minimum investment requirements in recent years. Charles Schwab, Fidelity, and Vanguard all allow you to start investing with any amount. This removes the biggest barrier that stopped previous generations from investing early. Robo-advisors like Betterment and Wealthfront handle everything automatically for beginners. You answer basic questions about age and risk tolerance, then they build and maintain a diversified portfolio. Annual fees typically range from 0.25% to 0.50% of your account value. Self-directed investing through traditional brokerages costs less but requires more knowledge and time commitment. Asset allocation means dividing money between stocks and bonds based on your timeline. A common rule suggests subtracting your age from 110 to determine stock percentage. A 25-year-old might hold 85% stocks and 15% bonds, while a 40-year-old might prefer 70% stocks and 30% bonds. Stocks grow faster but fluctuate more, while bonds provide stability with lower returns. Choose broad market index funds that own hundreds or thousands of companies automatically. Total stock market funds spread risk across entire economies rather than betting on individual companies. Expense ratios below 0.20% keep costs low enough that fees won't significantly impact long-term growth. Set up automatic monthly contributions to remove emotions from investing decisions. Market volatility creates fear that stops people from investing consistently. Automatic transfers treat investing like any other monthly bill, ensuring you buy shares during both good and bad market periods. Chapter 14, Retirement. Can it ever happen for me? Part 1. Addressing Millennial Retirement Skepticism. Your grandparents might have worried about having enough for a comfortable rocking chair, but you're wondering if retirement even exists anymore. Let's be honest about what you're facing. Social Security might not disappear entirely, but it's not exactly in great shape either. The Social Security Administration's own trustees report that the trust fund could be depleted by 2034, which would mean benefit cuts of about 20% unless Congress acts. That's not fear-mongering, that's math from the government's own accountants. Your parents might have had pensions that guaranteed monthly checks for life. Today, only about 15% of private sector workers have access to traditional pension plans, down from 60% in the 1980s. Companies decided it was cheaper to hand you a 401k and wish you luck. The responsibility shifted from your employer's shoulders to yours, and nobody gave you a manual. Meanwhile, you're dealing with student loans that would make previous generations' fate, housing costs that eat up larger chunks of income than ever before, and wages that haven't kept pace with inflation for decades. When a Netflix subscription feels like a luxury purchase, saving for something 40 years away seems impossible. But here's where the story gets interesting. Katie Couric started saving $100 per month in her 20s while working as a desk assistant making $15,000 annually. She increased contributions with every raise. Today, she credits that early start with much of her financial security. Despite not becoming wealthy until later in her career, the brutal truth is that waiting to see if retirement is feasible guarantees it won't be. Markets reward time more generously than they reward money. Someone who saves $200 monthly from age 25 to 35 and stops will likely have more at 65 than someone who saves $400 monthly from 35 to 65. That's compound growth doing the heavy lifting. Yes, the rules changed without your permission. Yes, you're carrying heavier financial burdens than previous generations. But millions of millennials are quietly building wealth despite these challenges. They're not earning six-figure salaries or receiving inheritance windfalls. They're simply starting now with whatever they can afford and increasing systematically over time. The question isn't whether retirement is possible, it's whether you'll make it possible through your choices today. Every month you delay makes the mountain steeper to climb. Part 2. Understanding retirement account types. Retirement accounts come in several flavors, each with different tax rules and contribution limits that can make your head spin. Think of it like choosing between different savings buckets, where each bucket has unique benefits and restrictions. The key is understanding which buckets work best for your current situation. The traditional 401k represents the most common employer-sponsored retirement account. When you contribute to a traditional 401k, you reduce your current taxable income. If you earn $50,000 and contribute $5,000, you only pay taxes on $45,000 that year. The catch? You'll pay taxes when you withdraw the money in retirement. For 2024, you can contribute up to $23,000 annually, or $30,500 if you're 50 or older. Roth 401ks flip this arrangement entirely. You pay taxes on your contributions now, but withdrawals in retirement are completely tax-free. This makes sense if you expect to be in a higher tax bracket later. Imagine you're 25, earning $40,000, and likely to earn more throughout your career. Paying taxes at today's lower rate might beat paying at tomorrow's higher rate. Individual retirement accounts, IRAs, offer similar traditional versus Roth choices. Traditional IRAs provide tax deductions now, with taxed withdrawals later. Roth IRAs use after-tax dollars for tax-free retirement income. The 2024 contribution limit for both IRA types is $7,000, or $8,000 if you're 50 plus. Here's where employer matching becomes crucial. If your company matches 401k contributions, prioritize capturing that full match before anything else. This represents guaranteed 100% returns on your money. Missing employer matches is like leaving free money on the table. Self-employed individuals can access SEP IRAs, which allow much higher contribution limits based on business income. These accounts follow traditional IRA tax rules, but accommodate the irregular income patterns common in freelance work. Health savings accounts, HSAs, function as stealth retirement accounts. While designed for medical expenses, HSAs offer triple tax benefits, deductible contributions, tax-free growth, and tax-free withdrawals for qualified expenses. After age 65, you can withdraw HSA funds for any purpose, paying only regular income taxes like traditional retirement accounts. Most people should start with employer 401k matching, then consider Roth accounts if they're young and in lower tax brackets. Traditional accounts make sense for higher earners seeking immediate tax relief. The perfect choice matters less than starting consistently with whatever option you have available today. Part 3. Calculating how much you need for retirement. Most people approach retirement planning like ordering at a restaurant, without seeing a menu or knowing the prices. Let's make this concrete. Sarah, a 28-year-old teacher, earns $45,000 annually. She wonders how much she needs saved by age 65. Here's how to figure it out. Start with the 80% rule. Most retirees need about 80% of their pre-retirement income to maintain their lifestyle. Why not 100%? You'll stop commuting, buying work clothes, and contributing to retirement accounts. Sarah would need roughly $36,000 per year in today's buying power. But money loses value over time. That $36,000 will need to be much larger in 37 years. Using a 3% inflation rate, Sarah actually needs about $87,000 annually when she retires. This sounds terrifying, but don't panic yet. Enter the 4% withdrawal rule. Financial planners use this guideline based on research showing retirees can withdraw 4% of their nest egg annually without running out of money. If Sarah needs $87,000 per year, she'd need $2.175 million saved. Again, breathe. We're not done calculating. Social Security will cover part of this need. The average Social Security benefit replaces about 40% of pre-retirement income for middle earners. That's roughly $35,000 of Sarah's annual need, leaving $52,000 she must fund herself. Now she needs $1.3 million in savings. Working backwards, Sarah needs to save about $300 monthly to reach this goal, assuming 6% annual investment returns. That's $3,600 per year, or 8% of her current salary. Manageable, especially if she gets employer matching. Healthcare deserves special attention. A 65-year-old couple retiring today needs approximately $300,000 just for medical expenses throughout retirement. Factor this into your planning early. These calculations aren't perfect. You might retire earlier or later, earn more or less, or face different inflation rates. The key insight? Starting with rough estimates beats waiting for perfect numbers. Fidelity found that people who check their retirement accounts quarterly save 2.3 times more than those who never check. Your retirement needs will change as your income grows, life circumstances shift, and you get closer to retirement. Recalculate every few years, but start saving now with whatever estimate you have. The biggest retirement planning mistake isn't getting the numbers wrong initially. It's not starting because the numbers feel overwhelming or uncertain. Part 4. Creating a retirement savings strategy. The 15% retirement savings rule sounds impossible when you're drowning in student loans and can barely afford rent. Netflix started contributing 15% to employee retirement accounts automatically in 2012. But they didn't expect new hires making $35,000 to save that much immediately. Neither should you. The 15% target represents your end goal, not your starting point. Begin wherever your budget allows, even if that's just 1% of your income. Target date funds at Vanguard show people who start saving 3% in their 20s and increase by 1% annually reach comfortable retirement savings by age 65. The key lies in gradual increases tied to raises and promotions. When you get a 3% raise, bump your retirement contribution by 1%. You still get more take-home pay while building future wealth. Prioritize your accounts strategically. Contribute enough to your 401k to capture any employer match first. This free money beats paying off debt or building emergency funds. After maximizing the match, split additional savings between retirement and other goals based on your situation. Someone with high-interest credit card debt might go 60% debt payoff, 40% retirement. Others might reverse those percentages. Automate everything to remove willpower from the equation. Dropbox increased employee 401k participation from 68% to 93%. Simply by making contributions automatic with opt-out options, instead of requiring active enrollment. Set up automatic transfers the day after payday. Schedule annual contribution increases during your work anniversary month. Asset allocation matters less than consistency when you're starting out. A simple target date fund handles rebalancing automatically and becomes more conservative as you approach retirement. Fidelity data shows people using target date funds save more consistently than those picking individual investments, probably because simplicity reduces decision fatigue. Your strategy will evolve As income grows and circumstances change, Amazon's Jeff Bezos famously lived in a small apartment and drove a Honda while building his company, then dramatically increased his retirement contributions as Amazon's value grew. Review and adjust your savings rate annually, but never let perfect become the enemy of good enough. Starting small beats waiting until you can save 15%. A 25-year-old saving $50 monthly will have more at retirement than someone who waits until 35 to save $200 monthly, assuming identical investment returns. Time amplifies small contributions through compound growth in ways that feel almost magical.